trades with just a few clicks. Wow, that's fast. Tasty Trade. Make your move.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. SIBO is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, two female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the SIBO's SPX pit. Watch Liz and Jenny live from the SIBO, only on Tasty Live.
Move with the rhythm, shake it up, stop when the clock hits 13. Sing 1, 2, 3, 4. Cause no one can do it like we do it, like we do it, like we do it. Cause no one can do it like we do it, like we do it, like we do it.
Can we get much higher? So high. It is Thursday, January 23rd, 2025. It is overtime. I'm your host, Chris Vecchio, here in New York. Ilya Spivak in San Francisco. Dylan Radigan, I think, on a safari in Africa. We're here for the next hour as we get ready to wrap up this futures trading day. If you're joining us on the platform or on the website, come over to YouTube. Tell us what you're trading, what you think of this market action. If you're already on YouTube, come over to the website or the platform. See what we're all about, tastylive.com. Guys, it's a day where stocks start the evening, or rather the morning, lower, thanks to some of the news we saw yesterday evening. SK Hynix, the South Korean chip manufacturer that supplies the high bandwidth memory chips to NVIDIA, gives some less favorable, less optimistic forward guidance than what people were hoping for. And semiconductors start the day a little bit lower. NVIDIA is down by a few percent. But that's really it. We get to the U.S. market open here today, and once U.S. liquidity comes online, stocks begin their ascent higher. We have a nice little bang on up into the close here, a zero DTE squeeze. 61.32 or so, all the way up to about 61.50 before the market took a breather here. Ilya, the news regarding tech stocks overnight wasn't fantastic, but all things considered, the market didn't take issue with what Trump had to say today at the WEF, the World Economic Forum. Are we in a Goldilocks type of market still?
It doesn't look like anything has materially changed from yesterday to today. I mean, if you look at where we sit on the S&P overall, we're basically at December's highs. So we had some back and forth at the start of the year here, a bunch of repricing, bunch of repositioning, bunch of capital deployed and redeployed, and we're basically back at the deciding line. So what has changed, really? Not much. At this point, yesterday as today, my upshot is if you thought that December was a top and that's where you started to sell, as I did, you're basically back to scratch and you're waiting. If you want to be long, the risk reward to doing that with a new entry here makes very little sense unless you break that high, in which case it makes all the sense in the world. If you've been holding long, getting out makes no sense because you've had lots of wind at your back. If you've been holding short, you've not been proven wrong. So at this point, what is there to do? Not much.
Get more long. Dylan, what are your thoughts?
I know that sounds like a joke, but I think the thing that is left to do is to become more deeply invested in the glorious abundance that is about to yield unto thee and ye until inflation comes to take it away from you.
It's interesting that you mentioned inflation because that was certainly the thread that kind of followed through Trump's speech today at the WEF. I was mistaken earlier. He wasn't talking about blowing up cold fronts. He was talking about blowing up coal, which I still don't understand in the context of the general commentary he was making, but we're all relearning to speak Trump again. Nevertheless, that threat of inflation, if you tug on his comments today, there's really three things that he cared about most. He was talking about tariffs and how if you bring your manufacturing and make your goods here in the United States, you get a 15% corporate tax rate. That's great. If not, you're going to face very steep tariffs. He wants lower oil prices. He was telling the audience today that he wants OPEC and Saudi Arabia to pump more out of the ground. And he was also calling for lower interest rates. He didn't just say it at the WEF today. He said it again this afternoon, not just from the Fed. He thinks that central banks globally need to lower interest rates. Forget whether or not this will actually happen. He doesn't control OPEC. He has no influence over the Federal Reserve, let alone what the ECB, BOJ, or any other central bank does. But you can kind of see the contours of what Trump's stated goals are, at least publicly. He wants lower oil prices, which, if you think that the dollar is a petrocurrency, which I do, that's where you get a weaker dollar coming out of this. The tariffs probably fight against those goals, but lower oil, lower dollar, you could then have lower interest rates if energy prices are more contained. What were your thoughts coming out of that hodgepodge of remarks today at the WEF? Did you see that there is at least some semblance of a stated policy outcome here that Trump's looking for? Ilya?
As I look at this, it basically rhymes with the idea that we don't know anything yet, because none of this represents meaningful difference from what we had in December, which is why when I look at what's occurred here, the sort of mid-December to sort of second half of December to second half of January shuffle, if you will, you really haven't changed any of the makeup of what's going on. And the give and take has only taught you one thing. We know what the upside is. We don't know what the downside is. And the Fed and yields are spooking markets. So we don't know how much tariffs we're likely to get or not get. We just know that the new administration likes them. We knew that back in December. We have no more clarity. We know that the administration wants deregulation. How and to what extent, we don't know, and still that's an open question. We know that they want to, at minimum, renew the tax cuts from Trump's first administration, but we don't know what else they want to do or can do. Things like no taxes on tips, say. Might that unleash more U.S. consumption potential? Who knows whether it even materializes. Those kinds of things need to get voted on in the legislature. So as we look at all of this, do we know anything new? No, we don't. We're still left with basically the same basic architecture of what Trump wants is more inflation, looking at the policies that he's talking about. And yet he seems to, on the other side, want easier monetary policy. And yet at the same time, as you've just mentioned, he seems not to want price growth. All of this sounds very Erdoganish if you're a follower of Turkish monetary policy and the lovely experience they've had. That economy has basically fallen apart multiple times over in recent years because of the president's, let us say, misplaced diagnosis that interest rate hikes cause inflation as opposed to the other way around. So what we have here is very inconsistent, very kind of muddy, but the overall structure of what we knew a month ago, 2 months ago, none of it has changed. And so far, it's actually U.S. growth that's the beneficiary overall, because it looks like it's the growth side that we're pressing first. and the anti-growth side, like the tariffs, that we're walking more slowly. But of course, that has a dark side, higher yields. That just means more inflation. So far, the only thing that the markets have anything to hold on to, as far as maybe it's not so bad, is one CPI report. It's not exactly a whole lot. So at this juncture, the risk still is the same. Tons of redemptions, higher interest rates, lopsided growth, which we're going to see in the upcoming PMI numbers here over the next 24 hours, where the U.S. is starting to approach the edges of the stratosphere. Meanwhile, everybody else still can't get the engine turned on. So we're looking at a situation that doesn't look any more encouraging for me. The question really is price action. Can you get past these highs? That would tell you that the markets want to shrug off the risks and continue to inflate the bubble, in your parlance, Chris. And maybe so.
But I mean, do you think is there any context for there's a context for when you have a concentration of wealth within, or concentration of performance within the S&P 500 relative, yes, where 5 companies or 80% of it or whatever. Mm-hmm. Is there a context for when global economies have such a wide divergence in the rate of growth, relative rate of growth between the UK and the US, or between, you can all the comparisons. I mean, my point is, I guess, is there any insight in that, in the spread in those relative growth rates, or is it just a notable anecdote at this point?
I think it's very, very telling, because when this kind of thing happens, you start to have a single point of failure. And we had this kind of a thing in slow motion, as it were, in, let's call it 2006, 2008, where obviously the crisis started in the US, but the global reckoning was delayed by a year and a half, because growth was still okay in the Eurozone, growth was still okay in China, and things managed to hold up until, of course, the problems in the world's largest economy ultimately had the contagious effect that they were always going to have. Right now, if the US were to misstep, there isn't that buffer. Moreover, we have had one of the most expansive rate hike campaigns in history. Certainly on par with the only other comparable episode in the history of modern finance since the 1970s, which was, of course, the Volcker disinflation. So we're looking at a very kind of dangerous set of circumstances here. There's a big refinancing cliff for governments and corporates, unlike last year. Rates on those amortizations 3, 4, 5 times higher than when those loans were incurred. And if only the U.S. continues to perform as strong as it is, that just means higher borrowing costs on everyone. Because when rates go up in the U.S., they go up globally. And while the U.S. is in fact growing very strongly and could grow their way to refinancing, everywhere else the story is not that. So this kind of a lopsided situation is, I can't think of another episode, let's say from 1970s onward, where it was this collection of catalysts together. Can you, Chris? And is your audio on?
No, I'm just ruminating right now because I'm trying to think. I don't know, but I think, so much is about sentiment and positioning in the market. And the positioning, at least in stocks, is actually not that high. We were looking at the positioning on Tuesday on Futures Power Hour, I believe, and I'm just going to pull this up for the sake of making sure I have the right number. The rolling 10-year Z-score for ES speculative positioning is only plus 0.34. For the NASDAQ, it's plus 0.04. I mean, it's the NASDAQ positioning right now is basically at the, basically on the screws. It's not extreme whatsoever. The most extreme positioning right now on the board is ZB with a Z-score of plus 1.26. But I think if you have a market that has been nervous and people have had a lot of capital on the sidelines and been waiting to see if taxes are going to change or regulations change, we could be in the, late innings. And if all these activities that I'm seeing correspond to a market that's going to go into like the top phase, like the last swing up. And that's not because Trump's president, just because we're getting the set of policies that would be accretive to the market inflating itself and then crashing down. And I think if we look to history anyhow, the market's averaged a 20% correction every 3 years or so since World War II. So Biden had one. Trump, of course, had his during COVID. The odds are that you're going to get one in the next few years, considering it's been 2 years in a row, back-to-back gains over 20%. So seeing something come around the corner and say 2026 wouldn't be a shocker. But right now we're kicking the can down the road. People are underinvested. Saudi Arabia is going to round off their investment into the U.S. to $1 trillion.
Maybe.
Right, Radigan? That's what Trump says today.
100%.
But isn't this
like 600? Let's
Trump
round that
runs
up.
Between a half a trillion and a trillion every day. This guy.
But if that even so, like, isn't it just the general?
That's the reason why my attitude is spend less time evaluating Trump and more time getting more long, getting more involved, getting more into this, because it's going to be a permissive and abundant environment with a lot more risk than usual. And so your choice is either to play into it or to try to hide from it. And I just don't know how you would hide from it.
No. As we said yesterday, it seems like a high risk, high reward kind of environment on the whole.
Dylan, I'm not sure if people were able to catch you last night on Stephanie Ruhl's show, former CNBC host, now on MSNBC. I had a chance to listen to it a little bit. What do you think the most pertinent point you made was last night?
I mean, for sure, the only point that I was making with Stephanie last night, or have been making, whenever people ask me the question, is that it is a mischaracterization to say that there's a mandate for Donald Trump to be the president when 2 out of 3 eligible voters did not vote for him. The largest voting constituency in the United States is no voters. I think I said this on this show in the past couple of days. So I'm being redundant. But I think my point is that people misperceive or mischaracterize the situation to make it seem as though the majority of the country is in support of Biden or Trump or whoever, when it's factually incorrect, and they throw away the no voter as too bad, you lose, whatever, all the sort of dismissals, which may well be perfectly valid as a dismissal, but it does not mean that those votes also do not represent people who refuse to engage in support of either candidate and feel a lack of support, that they represent a human sentiment that is not in support of the president. Maybe it's in support of the president, who knows, but it didn't vote for that presidential candidate. And I just think that if you integrated the no voter as a no confidence vote into the narrative of the news cycle, that you would not be, you would, instead of saying, why does everybody love this person, a Democrat or a Republican, you'd be saying, how much longer are we going to tolerate both of these failing political parties when the vast majority of us don't want either of these organizations responsible for selecting our leadership?
I'm looking in the comments and I'm seeing a lot of people saying there's not really a difference between the two parties. Both parties like spending, and they're, when Democrats
both preserve themselves.
Yeah, they're like
in their self-interest, like a corporation.
Well, I mean, that's the whole. That's once you understand that a political party's sole purpose is to gain power, and you start with that North Star, then it's like, oh yeah. But the partisanship here, it's not about cutting the spending. The spending is remaining, as some people in the chat are noting. It's just going to different sources. Both parties are addicted to the deficit spending, and that's clearly not changing here up front in the early days. Even the signaling around the tax cuts, will we get a resuscitation of the state and local tax deduction? It's a very thin majority, so you're going to have to cut deals and give people in swing districts pork to make it happen.
And of course, the thing expires anyway. As we heard pointed out over the past 24 hours, if you don't extend the tax cuts, you get all of SALT back. There's not even a negotiation because the thing expires. So you're going to have to bring something back to get a deal, or else no deal brings everything back and the deficit is aggravated even further.
Which means I'm getting a tax cut, baby. That's all that matters.
Those of us here in high state and local tax areas, San Francisco, will certainly welcome some sort of a compromise on this.
I mean, I think the question I would ask myself, and certainly to you, Ilya and Chris, is: are you surprised at the relatively benign, like that CPI, that inflation is not more present?
No,
you're not.
I'm not surprised. I'm not surprised. I mean, we're basically tinkering at the margins. I mean, if you look at what the markets grabbed onto, it's not the headline number. The headline number was actually higher. It actually went up to 2.9%. What people got so enthused about was the slightly lower core number, and that the slightly lower core number came for the right reasons. The issue at the headline was energy, and the Fed can't do anything about that. And if crude oil continues to behave the way it's more recently behaving, that is, if it continues to fall, as I hope it does, I am short after all, then you get a situation where as long as the headline keeps doing what it's doing, then the Fed is going to get to where it wants to go eventually. The problem is that 3.2% core is not exactly a low number.
No, what's really interesting, though, and I think this is worth discussing, a little thing went under the radar last year. I'm going to talk about this here first. This is the appetizer. Last year, the Federal Reserve Bank of Richmond started talking about how there was this new gauge of rents in the country called the New Tenant Rent Index, which was being maintained at that point by the Bureau of Labor Statistics. I point that out because this chart from Augur Infinity has the new tenant rent index with a 9-month lead overlaid with CPI rent. We know that CPI and OER, there's that big lag problem where there's the stickiness in shelter inflation. But if we think about this new measure of rents that the Fed's been keeping track of, and we look at it, how it moves, that makes sense, right? If rents are going up, then that filters through down to the economy. House prices up, then everything else is going up too. Here, it's looking like we have some serious deflation coming down the pipeline. Granted, not deflation and everything, but one of the major factors that was pushing up CPI throughout 2022 and 2023 is in a position now where it should be a significant headwind for inflation, right? It should make it more difficult for prices to climb in the headline indexes. And that's why I think this conversation that Trump's saying today matters so much, right? Can he actually get lower oil prices? I mean, he could give us a security deal with Saudi Arabia. The U.S. defense umbrella extends there as is extended to Japan, to South Korea. And in return, Saudi Arabia promises to pump a certain amount of oil out of the ground every single day. The only way that OPEC and the rest of those countries be able to keep the price of oil up is to cut their own production, which means they starve themselves of a fiscal revenue. So they'll be forced to do nothing but go along. And it reminds me of a gray swan I identified a few years ago that obviously never played out, but it was, what if you have an oil arrangement between Saudi Arabia, the U.S., and like Russia? That sidelines the rest of OPEC completely. And under a U.S.-Saudi deal, you could have lower oil prices that then feed into lower inflation, and then the Fed can cut those rates. And Dylan, if we have the Federal Reserve that by the summer is back on its rate cuts, and we've seen that this inflation bump hasn't materialized, and the unemployment rate stays with the 4 handle, and U.S. GDP is still moving in a 2 to 3% range, I'd remind everyone, and Ilya, you know this, takes about 9 to 12 months for monetary policy or fiscal policy changes to filter through into the broader economy. So the actual real impacts through the data, the broad stroke, and the adjustments that the economy makes as a result of even just these executive orders this week will not be in the data until the second half of this year. And whatever fiscal policy changes occur, if it's the extension of the Trump tax plan, that probably doesn't happen until next year, the impact being felt. So right now, we're still riding the rails of the economy that we had in 2024. 4 handle on unemployment, 2 handle on inflation, 2 to 3% real GDP, right? And that gives you an SPX cash index that's closing at a new all-time high today. So I suppose stocks are doing well. I continue to add exposure because I think we're in the midst of the next leg up. I used the pullback today in SMH to, at the open, purchase 280 calls here. I'm still long the 260, 270 call spread. Also added a 280, 290 call spread here onto the docket. Likewise, with that weakness this morning out of the gate, used it to leg into XLY call spread, long the 240, short the 250. I'm positioned for this market to rip into new highs. And so I fully expect that to happen here over the next few days. And if it doesn't, then I'll be out some money. But if not, then if things go according to plan, then, we're going to wrap up January here with a double-digit gain on the board for the first month of the year. So I'm quite content with that.
One thing to keep in mind, if you look at the PCE data, the housing component contribution to headline inflation, and I look at PCE here because CPI is not as clean on this division, but for PCE, you can very easily sort of chip out housing and say, here's the contribution from housing. Of the recent numbers, we haven't had the December update yet, so this is November. December is likely to be more of the same in terms of the components, but higher on the rate. Housing is about half the contribution to inflation that core services is. And core services accounted in November for 73% of all inflation. Housing is a pittance. So when you consider, okay, yes, rents seem to have a nice tailwind for inflation, but unless you get the service sector situation handled, inflation isn't coming down. And dealing with that service sector situation, what that means is unclear. Because if we are going to ramp up the economy as the new administration wants, and that's going to drive up yields, as has been the consequence of expectations that that'll happen, then you have a situation where you're not going to have the cool down in the most important part of this matrix. It's just not going to happen. And if you add on top all of the issues with the potential for tit for tat, trade wars, blah, 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 et cetera, this could become a very different kind of story. Now, I'm not terribly concerned that inflation is going to crash the U.S. economy. That's not a risk that's meaningfully on the menu because the U.S. is, in fact, growing fast enough to manage higher yields, or so it seems. The level of consternation in bond markets, in corporate credit seems to be minimal at best. So it doesn't look like anybody's worried about real credit stress in the U.S. The issue is elsewhere. The issue is for virtually every other economy, which has to, because of U.S. outperformance, deal with higher yields. Meanwhile, none of the U.S. outperformance is spilling abroad because all of it is service sector demand, not goods demand. And most of that demand is serviced by domestic U.S. firms. Hence the doldrums in Canada, even as the U.S. is as strong as it is and as tied to the U.S. hip as Canada's economy is. So you have the danger here of basically a two-phased kind of a problem, where first higher yields essentially crush the rest of the globe global economy, and the multinationals in the S&P see that as a consequence in their earnings abroad, only for that then to backfill and hit the U.S. downwind. And of course, when that happens, you have a much bigger issue. Now, still possible the world economy could grow out of this if what's going on in the U.S. starts to spill over, finally. And maybe it will. We are looking at sort of historic disconnect in terms of spending on services versus on goods. If we start to rebalance a little in the U.S., if we start to feel rich, as it were, and start to buy more from abroad, that would start to emanate good vibes elsewhere, and the world economy could, in fact, overcome all of this and grow out of it. Not if you have a tariff war, though.
Is there a tariff war coming, though, Dylan? Look at Mexican stocks here.
Who knows, right? I mean, some tariffs will be coming for sure. I would say at least extremely likely. Shocking to not have some tariffs at this point, but there's some difference between some tariffs for theatrical reasons for the performance of the U.S. president and a full-on tariff war. There's a range of possibilities there, and to the degree to which I don't see how the stock market or the bond market would be where it is if a tariff war was nearby.
I think the Mexican ETF is what we should be looking at here. EWW is showing some really interesting bottoming price action right now. The lows that we had in November and December, which we cleared out going into the end of last year, the start of this one, we've rebounded through. Ilya, you like those horizontal lines? That looks like support and then turn resistance. We'll call it 48.5, 49.
I'm watching this one very closely.
This becomes one of those maybe it's not. This doesn't feel like a typical tasty trade, right? No. Nick Batista and I were talking. Longer. Yeah, Nick Batista and I yesterday were talking about trade setups in ASML, and he was thinking, I would prefer to go like leap type of strategy here. Go out 6, 9, 12 months, look at like the $900 calls, just not timing this, but it looks like it's rounding out into a bottom. And so if it's now or in a month, at least I have that upside exposure. It feels like that's the way that we should be playing Mexican stocks because it's only a 38.
I made this mistake with iClean, the
ICLN, yeah.
Yeah, I should have had more duration.
That makes sense.
I should have had more. I should have had a lot more duration there. So obviously, I was talking about shorting it as soon as Trump became elected and the clean energy ETF gapped down. I did short it. It has worked very well, but it could have been much more capital efficient and cost much less money to manage were I to put like a year of duration in there from the jump.
148 days to expiration, long 55, short 60, call spread in EWW. $62 of buying power. Max loss of $62 against a max profit of $438. Yeah, that's
excellent risk reward. You can dial up that size a little.
That's going into the queue for tomorrow morning. That's a review and send. That needs to go into the queue for tomorrow morning. I think Donald Trump is bluffing on everything. I'm listening to him talk about what he wants to accomplish. He is clearly twisting arms right now. This is not my cup of tea.
This is the snippet right here. We clip this for YouTube upload later.
And this is also to remind me when he does something really dumb. It's like, well, maybe he wasn't just saying those things.
Either way, that's the thing.
The risk to reward here right now, I think, is fantastic. The bet effectively is that we're going to return to where we were right after the election. We traded at $54 at the high on November 7th here. There is a long runway, Dylan. And as we were talking about this last week, so sticking to the pre-inauguration expectations, every day that goes by without the big tariffs, the market is going to take the threat of a significant sweeping tariff war less and less seriously. And we're going to understand that it's more of a negotiating tool than an attempt to just remake the global economy in Trump's image. I find this really compelling right now. Today's a little bit of a rejection, but we still trade higher. We're back above the entirety of the EMA cloud right now. If the dollar's topping,
so what? Let's assume that the whole tariff thing is rhetorical.
it's not just rhetorical, but it's mostly rhetorical.
Mostly rhetorical. That it is rhetorical with some performative implementations. Do you think Mexico is the biggest opportunity? You think the reason Mexico's chart looks the way it does is because of fear of that tariff war?
Absolutely.
Do you think the Canadian? So what about the Canadian dollar? And by the same logic.
Well, that's what the Canadian
dollars
is a really interesting chart too. Kind of looks like EWW, doesn't it?
That's what I'm saying.
Just trying to break a downtrend that's been in place over the past 7 months.
I'm along with this already.
Yeah, if the dollar's topping, and that's really the story here, then you have to then work recursively backwards from, well, the dollar wouldn't be going down if the tariff war is raging. So the tariff war must not be raging.
Right.
Very simple. Just regress against that belief, right? That's our model that we're going to work with.
Moreover, if the tariff war isn't raging and Canada has gotten rid of its unpopular leadership and is on course to install leadership that we'll see if it's better or not, but at least is more animating.
It'll be new, which is
it'll be new. It'll be animating of animal spirits until proven otherwise.
Yeah.
And
so
would you rather own the Canadian dollar or the Mexican index or both?
We don't have to make that decision, Dylan. Let's just put put together the basket, right?
We're just getting short the tariff war right here, right? And that's what's going on.
I mean, so far I have the Canadian dollar. Mexican ETF is very shortly behind it. I'm not quite ready to load it in there as Chris has. I want to see it maybe have another day on the upside tomorrow.
Are you ready to be short the tariff war conceptually?
I think the tariff war conceptually was always likely to be less onerous than kind of the absolute worst fears. And I'm surprised the market has given it as much concern as it has. That doesn't mean that it's not going to be a tariff war. It, I think, means that we have less of a reactive thing here, because ultimately it is a negotiating tactic. And I think the markets were essentially expecting Smoot-Hawley Part 2 at the start here, and I don't think that's the level of concern. That doesn't mean that there's not concern. It just means that the pricing of things is probably out of whack.
Just gaming this out, Trump has signaled that he wants to go to China. Do we think that Trump does the trade war, does the 25% across the bow tariff before he sits down with Xi Jinping? There's a chance, but that probably sets that meeting off on bad footing, right? If you're really going in there saying, like, listen, we don't want to do the tariffs, but we're going to do them unless we can come to some sort of arrangement, you try to hammer out that arrangement first, do you not?
I would think so.
Right?
I would think so. I mean, I think that slowing the TikTok ban maybe tells you something about this. Like,
that's part of it.
If the plan was to basically go to China, having already kicked some stuff over and said, wouldn't it be terrible if I kicked more stuff over? Let's have a deal. That's one way of doing it. The more benign way of doing it is to send the nice bill collector first and say, listen, I don't want to have to start kicking stuff over. And I don't want to kick anything over. Let's just do this deal, and then I don't have to. And the TikTok slow walk may be a part of that. It might be that we're just not in a place where we're going to start kicking stuff over unless and until.
There may be a short-term window where the market just says, okay, these problems aren't really problems. I'm not short the trade war, Dylan, like it's coming. I just think that maybe to the degree that we thought it would arrive, that the time scale were off and the magnitude were off as well. So if it's
Exactly.
later and shallower, then the market's been pricing in a world that will never come to fruition, even if the trade war does arrive. And I would think from a negotiating standpoint, if Trump's going to go to China, he's doing it either well after a first layer of tariffs have been put into place, so he can say, see, we've tried this. We've done 3 or 6 months with this new trade regime. Everyone's suffering, right? Your economy's slowing down. Our goods are more expensive. Clearly, we need to fix the trade arrangement. Or he does it well before any change in tariffs go into place, so he can say, listen, I don't want to have to do this. But you don't put the tariffs on and then walk over there and say, see, look what I just did. There's no body of evidence to suggest that they were even effective, so why would China start negotiating at that point? I'm not expecting a Nixon in China moment, as it were, but the fact that that is there and there is this TikTok extension for 90 days makes me think that the near-term balance of risk, this tariff is the wall of worry right now for the market. At the end of the day, that's the number one thing dividing us between just the SPX cash index, perhaps moving up to all-time highs, and the NASDAQ and others beginning to follow suit. Ilya, I got to give you props here. As a bear, you nailed the move in the Russell. You got out on January 13th.
Yeah.
Which was pretty fortuitous timing. Granted, when you and
I ran away, yeah.
When you and I were talking
as it turns out at the right time.
But the perfect time, because when we look to the continuous contract and we go to the 200 SMA here, you could see that that was the day that we touched the 200 SMA, a 200 SMA that when we've touched it previous times, it's marked the low for the market over the past year. It also feels like we've now entered new territory here a little bit, because when we look to the continuous Russell, we see that one, my diagonal line has been broken, fine, but two, this horizontal line that we've been watching and have had here static on the continuous contract for months and months and months, we can make adjustments to try to justify that we're not really above it. We can make the line thicker or skinnier. This is a 5 thickness here. Can't go much thicker, Ilya. It looks like we're really trying to break out now in small caps.
It does. No, it does. It does.
Dylan, if small caps are doing it, then why not 2,500 Russell as well? Let's put those calls on the board.
You're saying that's on the Trump super boom?
Short term.
Or that's all.
Yeah.
Just party time. That's just a beneficiary of party time.
KRE, Ilya, you can look to XLF.
So this is really the thing. You look at KRE and you go, okay, well, bonds have pulled up a little, yields have become a little less worse. Makes sense what the Russell's doing. The question, as ever, is will bonds continue doing it? Now, I'm long, so I think yes. And part and parcel of this, very supportive for the Russell. If you think that bonds are going to rebound from here, that should be Russell positive. But so far, I've liked the bonds side of expressing this idea, because I can see how the Russell could get pulled into broader risk aversion were that to happen, whereas being long the bonds would only benefit from broader risk aversion. So if you want to keep things isolated to Russell and the bonds, then they should be going up together and have been recently. But if you want to sort of expand your viewpoint and go higher in the atmosphere for your vantage point, as those of us that are macro-minded tend to want to do, then you say, you know what, I don't want to be long equities in one pocket if I'm skittish about being long them overall. Instead, I'm just going to do the bonds themselves.
Sure. On the other hand, as Dylan might say, maybe it's party boy time.
Could be.
What do those Russell out of the money
calls?
Looks
like it to me. Sure looks like it to me.
I mean, if tomorrow we're through those highs on ES, it's on. Why not? I mean, literally, there's a 24-hour timeline on this thing now on any given day. It was a 24-hour timeline yesterday. It's a 24-hour timeline today. We keep scraping at the highs. It would take but one day through those highs, and we've turned the page. And December was not what December looked like. Or not.
Or not. I don't know. But the thing is we're beginning to break out. And if we're seeing the junk begin to rally, and the price action here today, very encouraging, right? Yesterday we have the pullback, but we don't pull back below that November 19th swing low. We don't clear out the swing highs we have in December, the beginning of January. We pull back into the EMA envelope, which holds up as support, and then the candle turns green for the day. This feels like if small caps lead mega cap tech tomorrow, it would not shock me whatsoever. Consistent with that, I'd like to get this on the board. I know we're not going to get it executed here, but 56 days to expiration. Let's see if we can get this filled when markets reopen later. Get it into the queue. Might as well. We're going to put all the chips into this corner right now. The market's shaping up for it. And I say shaping up for it because the VIX with the 15 handle, right? This has been one of those environments when the VIX is at 15 or so, and technical momentum is positive. I found my most success personally just blindly being long stocks and spending most of my time sorting through Excel spreadsheets and bothering Dr. Data to help me code some things into Python. When I overtrade and overthink, it doesn't really do well for me. So I think I'm content here, though, guys. We haven't necessarily talked about the sector performance today. Yesterday was a bloodbath. 6 of the 19 or rather 6 of the 25 were up, 19 of the 25 were down. Today is much better distribution. In fact, 19 of the 25 are up today. The 5 that are down, KRE off by 0.36, KBE off by 0.24, junior gold miners off by 0.15, semiconductors down by 0.12, and then gold miners GDX off by 0.08. OIH is unchanged. Everything else is in the green. It's biotech, it's retail, it's industrials, it's real estate. Dylan, part of the reason why I don't think
that's what party time looks like. Everybody wins. I think that at this point, again, the question is, where do you want to be for this party, and how risky is this party? The question is not, is there a party? There's a party.
Right. There's definitely a party. Yes.
And so that whether it's long the Canadian dollar and long Mexico, or whether it's long the Mag 7 or long the Russell, I mean, you can make a case for all of it.
Well, let's make a case here for the folks in the chat, because I want to redirect this chat into a more positive direction. What do you guys want to trade going into tomorrow for the end of the week? Let me know what ticker it is. We'll pull it up on the screen. Dylan, it feels like that, right? The party's on in certain corners of the market right now. There seems to be unbridled risk appetite by certain market participants. The animal spirits are on the rise. Is our only job as traders to make sure that we get a seat when when that music stops playing? We got to make sure that we drink from the punch bowl and consume as much as possible until it runs dry.
I mean, for sure, that's the magic trick, but that's easier. It's one of those things that's simple to say and hard to do. But I would say, yeah, I would almost get an appetite to sell, just to be selling underneath the S&P or the NASDAQ every month. Maybe at a little bit of distance, but.
Ilya, what are some of your favorite trades going into tomorrow? I see. Mm-hmm. Yeah, apparently Brondo coin is one of the requests for a ticker. We're going to, that might be more positive direction than what I've seen here recently. Okay. Ilya, we have the Bank of Japan tonight.
Yes.
Is this perhaps the tail risk catalyst that we're going to have a BOJ hike? We're going to get something that disrupts the market, broadly speaking?
The market is widely expecting this hike. I talked a lot about this in excruciating detail, no doubt, for anyone that was watching on Macro Money yesterday. The market absolutely expects this hike. There's no news there. The question is what the BOJ does with their signaling thereafter. Right now, there's one more hike expected this year for a total of 50 basis points this year. Now, what's interesting about all of this is, from the Bank of Japan's perspective, their only real issues are imported. All of their inflation are food and energy. Largely, these are a problem because the yen has been getting shellacked, and so its purchasing power has been eviscerated in recent months, which has made inflation worse. Their biggest mission is the affordability crisis in Japan, and the BOJ would love to get the yen stronger to help with that. But of course, the yen is a creature of global yields because of carry dynamics, and so is a creature of the Fed. So what the BOJ doesn't want to do is fight the Fed, which puts the BOJ squarely within the blast radius of the Trump administration's policies, because if they're inflationary and force the Fed to be more hawkish, well, good luck, Bank of Japan. You're going to deal with higher rates in the US and a weaker yen, which will complicate your mission. So if the Bank of Japan comes out here, I think that this is probably the most interesting part of this thing. If they come out and they say, we're hawkish, we might hike more, implicit in that is the bet that they think U.S. rates have topped, because they are not envisioning that they're going to have to fight the Fed to getting a stronger yen and to getting inflation down, imported inflation down, which is really the only kind that matters in Japan at this point. If, on the other hand, they're skittish and they say, food prices have a tail to higher inflation, but energy prices have a tail to lower inflation. Japanese CPI tends to lag global food and energy costs by about 7 months, and the tail there is conflicting. So we have time. We probably don't have a huge risk. Inflation is probably not running away on us. Let's wait until wage setting, and let's see what the Trump administration does for the next 2-3 months. That tells you they're not sure. And if they're not sure, never mind the impact on the yen, it would probably weaken a touch. The larger issue is that there's greater uncertainty more broadly and more widely, and so the bond market has implications there. If the BOJ is hawkish, very possible that they're essentially calling the bottom on the bond market.
On the U.S. bond market.
On the U.S. bond. Well, the only one that matters, really.
Mm-hmm. Because
of the ubiquity of the U.S. dollar, it is the U.S. rate structure that determines the direction of rates everywhere around the world. How is it that in the Eurozone rates are surging when they're cutting rates? Because they're not the ones that are in charge.
Interesting. Before we go out the door here, I did get a question in for people who, or someone was asking, I forget who it was in the chat, I can't find the question again, but they asked specifically, I want to somehow leverage long upside in SPY while limiting my risk for the incoming correction over the next year. What should I do? We actually talk about this a bit. You hear Victor Jones talk about this. JP Morgan has the hedged equity collar strategy. That's effectively what this is. You'd be doing a collar strategy here. You own the underlying asset. You're buying SPY. You're selling the out of the money call, and you're buying a deep in the money put. This limits your upside, of course, but it also caps your downside. The cost of it is what you're paying for the collar itself. Me in particular, right? I don't want to cap my upside ever, so I don't engage in trading strategies like this. But there's a way to go about doing it. JP Morgan, you could actually just buy the hedged equity collar ETF, I believe. I don't have the ticker in front of me. It's like GPHLQ or something. But either way, though, you could construct this yourself. So if you had the SPY shares, if you had your 100, 1,000, 10,000 SPY shares, whatever your holdings are, you could set up the appropriate buying the in-the-money puts and selling the out-of-money calls to collar effectively. Teach their own, though. I happen to think that if it's going to be a good year for stocks, it's going to be a great year for stocks because the distribution of gains, right, even though it's an average of about 8 or 9% per year since World War II, the good years are closer to 20%. The bad years are closer to negative 13%. So if it's good, it's going to be great. If it's bad, it's going to be terrible. It's less likely to be the average gain in and of itself. Guys, outside of adding XLY, SMH, what else did we do today here? There was some silver yesterday. We have to put these back on for tomorrow. Yeah, that's about it. I don't really see anything else going on right now because it's been a good day. It was a quiet day. The market moved up slowly, ground higher. Ilya, you are more than welcome to come aboard as we reach for the S&P 7,000 stars.
If it breaks, it breaks. And if it doesn't break, then my puts make money.
Dylan, final word here before we go.
I'm buying me some Mexico. I like the short tariff war. And Canada, I'm not going to get involved, but I like that Mexican ETF. I'm sort of the opposite of Ilya.
It's a tariff tiff, not a tariff war.
Mm-hmm.
With that, overtime is out of time. We'll be back on Monday because this is Thursday, so we're done for the week here. We are back on Tasty Live Monday through Thursday, 4 p.m. Eastern, 3 Central, right after last call, so be sure to join us. For Ilya Spivak and Dylan Radigan, I've been Chris Vecchio. Good luck trading. Ilya and I will see you tomorrow for Futures Power Hour, but you're also going to see Ilya next because he's here on Tasty for Macro Money after the break.
See you there, folks.
Started trading around 2018, as soon as I got out of college. Stumbled upon a couple of different YouTube videos and learned that way. Truth or skepticism with Dylan Radigan was actually kind of what really caught me in the early stages because Dylan was sort of the skeptic and like I was a skeptic as well. And Tom was able to sort of convince him and that was kind of my favorite show from the beginning. The fundamental principle that present fear of future uncertainty is fundamentally overpriced. In other words, volatility and selling volatility is the key to getting a statistical advantage in financial markets is the biggest takeaway. And that's kind of just the overarching principle I follow.
Calling all traders. Are you using Tasty Live mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, Tasty Live has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Looking for a better broker and a bonus? Sweet. We got you. Right now, you can get a bonus of up to $4,000 when you open and fund a Tasty Trade account. Plus, low rates, smart tech with the analysis tools you need, and award-winning support. So, get a broker who's actually got your back. And up to $4,000 at Tasty Trade. Make your move, genius. Tasty Trade.
How we respond to the most difficult situations is ultimately how we learn to build on our successes.
It takes the guesswork out of retail trading.
Just for a minute, let's forget about your favorite stocks. Just for 1 second, let's leave specific strategies on the shelf. Let's talk about what really matters. Your portfolio. How do you build it? What should you target? How do you manage it day to day? The answers to these questions and more are inside our newest crash course. So I'll see you there.
Forbes called us best online for options trading. With stockbrokers.com, we're number one for options and futures trading. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move. You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new Tasty Trade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? Tasty Trade. Make your move.
PMI data is due to show that the U.S. economy continues to soar, so what could possibly go wrong? That's what we're going to ask here on Macro Money. I'm Ilias Spivak, head of Global Macro here at Tasty Live. We have the upcoming January 1st look at Global Purchasing Manager Index, or PMI data, that is going to be in focus for us today. This, of course, is something that is a very closely watched way to estimate what global growth trends are if you don't want to get stuck looking at perennially delayed quarterly GDP numbers. Not only are they released late, but the trends they show are very dated by the time you get them. Markets, of course, still react, but that is not the most timely way of looking at things. These PMI numbers, however, are a great way to approximate. These are surveys of purchasing managers at large corporates that, because they have to manage inventories and such, have to, by virtue of what they do, look ahead. And so this becomes a good reflection of where global growth is going in a more timely way. And the expectations that we're looking at here for the major economies due to come across the wires here, they look relatively benign. If you look at the U.S., much less so if you look elsewhere, and generally in line with the trends that we have seen. So consider here that for the major economies here, the story is that of continuation. Slight positive growth in Australia, a little bit of a cool down maybe in Japan, but not much. About the same for the composite index there. The Eurozone still in trouble, third consecutive month of contraction expected there. Just to make sure that we're on the same page, the way that this is marked, of course, is around a center line of 50, which is neither growth nor expansion. Above 50 is growth. Below 50 is contraction. The more you get above 50, the faster the growth. The more you get below 50, the faster the contraction. And so what we're looking at then for the Eurozone in seeing a number that is sub 50 is contraction. And this would be the third consecutive month of that. On to the UK, relatively flatlined there. But for the US, strength on strength on strength. Another potent reading here. And in fact, if we want to consider what the trend here looks like, the history is very kind to comparison here. So we're looking in January for just a bit of a downtick on the composite as the service sector cools just a touch. And if we compare this to the recent history, the reference points take us all the way back to April of 2022. So very strong growth in the U.S. Here around this area that's relatively sort of elevated in the comeback from COVID story, of course, already on the way down from those heady catch-up levels as the economy was reopened and started to surge forward as things turned back on, but still very much at the high end of what has become the sort of post-COVID normal. Compare that with the Eurozone. So again, not much changed from December's numbers, but still relatively anemic. And extending this sort of slide from middle of 2024 that is now giving us the worst performance, if this comes out essentially as expected, the worst 3 months here since basically here, the beginning of 2024, the slowest 3-month run in a year. And the reason we focus on the US and the reason that we focus on the Eurozone and single those out is because, of course, the global economy is overwhelmingly driven by 3 major economies. The US is a little bit over a quarter. China is at 17%. The Eurozone is at 15%. And these 3 economies between them are 58% of global GDP. Moreover, the remaining 42% are mainly vendors that depend on buying from the larger 3 to have demand of their own. So think all of the economies of Central, Eastern Europe, Nordic Europe. When you're thinking of the Eurozone, think Canada, Mexico. When you're thinking of the US, think Australia, New Zealand, most of Southeast Asia, a lot of the commodity producers in South America when you think of China, and of course the commodity producers in Africa as well. So the impact that these 3 economies have is, in fact, even greater than their share of GDP suggests. And so the overall global pie really rests on these 3 pillars. And as we just saw, what these PMI numbers are going to show us that once again, the US stands alone, whereas the situation in the Eurozone is looking anemic. Now, we're not going to get updated numbers from China until next week, but we can see here that the situation there has basically struggled for liftoff since the country exited zero COVID restrictions in late 2022 going into 2023. We saw a bit of a rise in the service sector side of things as those that were in lockdown were let out. But since then, we can see within just a few months, the situation anchored back, this is the 50 line right here, to essentially hugging neutral. And that's if you look at the comparable S&P Global PMIs, which is what we have here, that's done in conjunction with Caixin, or the official ones that come out of China's government statisticians, the NBS as well as the CFLP, the purchasing and logistics arm. You can see here again, surge in early 2023 as you get this reopening, and then a kind of sinking to hug the neutral, not going anywhere, not growing, not shrinking kind of setting. That, of course, is how, when you look at the dynamics of overall global growth, you end up with something that is much more anemic than the U.S. situation would imply. So take a look at, once again, what's going on with the U.S. We're booming and we're sitting at levels that haven't been hit in over 2 years, 2.5 years, whereas when we look at these global averages, we're sitting at maybe on the composite index here, the highest levels since about mid last year. But ever since peaking in May, what we've seen is a deceleration. And largely, this is because what we're seeing in the U.S. is a story stuck in the U.S. rather than something that is going to emanate to the world at large. In fact, just last week, what we saw was CPI data that once again showed us that the service sector is overwhelmingly in charge when it comes to price structures. As a matter of fact, if we take a look at how much contribution there was to overall inflation from the service sector, it was a whopping 93%. And that has in fact been the norm in 2024, in 2023, where the economy is overwhelmingly skewed to the service sector. Compare that with 2021, 2022, where the average was closer to 35-40% of inflation was in the service sector. And that, of course, is an implication of demand. When there is greater demand, there is greater upward pull on prices. And so backing out from prices to look at, okay, well, all of inflation is apparently in services, that must be where all the demand is. That seems to explain how it is that you have the world's largest economy, the biggest contributor, in fact, to overall global GDP, surging, but the global economy is doing nothing of the sort. It's not falling apart, to be sure, but it appears more so to be idled in place around these levels here. So positive growth, but modest by comparison when we look at the heights being scaled by what's occurring in the U.S. This is, of course, because the services boom that we have in the U.S. is mainly serviced by domestic firms. That demand is satisfied largely in-house, as it were. In fact, the anemic state of Canada's economy, which has struggled to grow in any kind of capacity over recent years, is a case in point. Canada exports 80+% of everything it sells overseas to the US for obvious proximity reasons. But the US is booming, yet Canada is struggling. Were there to be spillover from the US and how strong it is, Canada would be the first place to look and see. And that spillover is plainly not there. So what we're looking at then is a situation where there is an increasingly lopsided story for growth, and that lopsided story certainly favors the US, but it leaves global growth without much of a leg to stand on in terms of lasting and building performance, because everywhere else appears to be weak, and of course, most notably in Europe and in China. Meanwhile, what's happening in the US is not making its way outward beyond US borders in any kind of a meaningful, accelerating way. There is, of course, a dark side to just staying inside the U.S. economy for growth where everywhere else is weak, because the thing that the U.S. is exporting, not demand, but higher interest rates. We can see here in the green is the U.S. 10-year. In the blue is an average of the 10-year rate for the other major economies here. Germany as a stand-in for the Eurozone, the UK, the Australian dollar, and Japan. These are the world's most traded currencies. And so these are the debt instruments that we're benchmarking for the global story. And what we find here is, while the Eurozone is seeing rate cuts, Japan is seeing rate hikes, but they're only very modest, and the UK is cutting rates, Australia is standing still, not exactly the world's greatest impetus there for higher rates, and they are surging nevertheless. And that's not just through this global hiking cycle, that's here and now. And that, of course, is because rates in the U.S. are doing that. And this speaks to, of course, the ubiquity of the U.S. dollar and its wide use in global commerce. So when the market takes a more hawkish view of the Fed, as they have in recent months, reckoning that essentially the strong U.S. economy will mean the Fed is not going to be in a position to cut rates as much as markets thought, or even as the Fed thought, that emanates out because the cost of borrowing dollars, because of the dollar's ubiquity, becomes the cost of borrowing for global business in general. So you're left with a situation where all the U.S. is doing for the global economy with its outperformance is introducing higher borrowing costs. And that, of course, is more digestible for the U.S. economy, which is growing quickly, and less digestible for the rest of the global economy, which isn't. And that comes at a time when stress is already rising on the credit structure globally. We can see here from the latest Global Debt Monitor report, this was published late December from the Institute of International Finance, we find here that there is a big redemption cliff, both for mature markets and even more so for emerging markets in the coming year. Moreover, the situation is going to be amplified unlike any other time in history, because as we've pointed out before, since the 1970s, which is essentially the birth of the modern financial system that occurs with the decoupling of the dollar from gold, every tightening cycle has seen corporates pay more in interest rate expense, except this one. So as we get 12 months into the beginning of, or from the beginning and into a rate hike cycle, in every other instance, there has been more interest to pay. Not this time, though, because corporates accumulated huge amounts of cheap money loans at essentially zero rates or close to it during COVID. Well, that's typically a 5-year kind of loan, and that would mean that it's going to be rolling over this year. So the disparity in rates for all of these outsized redemptions should be quite large for quite a lot of this debt. And if the U.S. continues to outperform as much as it has been outperforming, well, then we're looking at a situation where the story is all the more difficult because that outperformance is creating higher rates, just as the rest of the global economy that isn't the U.S. is having an increasingly hard time with growth and would not appreciate borrowing costs that are higher. And so what we end up with then is the lopsided nature of the pie becoming a major concern for global credit and for financial stability. In fact, the IIF in its report is pointedly warning that liquidity risk is increasingly a concern as things move forward. And that's what makes this PMI data such a big deal. Consider here the Citigroup Economic Surprise Index, which is showing us that for the Eurozone, the tendency for economic data has been to increasingly underperform relative to forecasts, whereas for the US, it has been pointed in the polar opposite direction. So if what we're going to look at here is surprise risk on the upside for the US and surprise risk on the downside for the Eurozone, if we're going to essentially, looking back at these overall numbers, end up with greater weakness here, but greater strength here, then this disparity at the heart of the story ends up looking wider. The wider the disparity, the more this becomes an issue. Because higher U.S. growth means higher U.S. rates, means higher rates everywhere, but everywhere is increasingly struggling to stomach it, especially if at the time this is what beckons ahead. So putting all of it together tells you that even as you get strong U.S. economic data, and even as that at face value encourages risk appetite, you may well get a negative response from markets as they look through and find in that data this, and begin to get worried that what this means is ultimately divestment and a more risk-averse perspective. As a matter of fact, that is precisely the logic that we've seen show up in stock markets in December. They've, of course, recovered and sit back at their December highs, currently looking at the S&P 500. But that spooking in December that led the sell-off, that was about rising rates. That was about this right here. And to the extent that this has scope to shutter markets again, because that disparity is looking increasingly lopsided in the PMI data, what may look like U.S. strength may in fact end up a growing concern for equities and for risk-oriented assets more broadly. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what may follow thereafter. I'm back with Chris for Futures Power Hour Fridays and Mondays, on with Victor Jones for The Price of Truth on Tuesdays, as well as with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter, as well as on Blue Sky. Thanks very much for joining. Macro Money's back next week. Take care.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new Tasty Trade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? Tasty Trade. Make your move. Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're #1 for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
One of the things that was most intriguing about the financial space to us is just that there wasn't a lot of vision, there wasn't a lot of innovation, and I think that left a door open for us, which we really liked. After almost 20 years of open outcry, standing in the pit trading, I felt like all the markets were moving from kind of traditional open outcry to electronic trading. I saw the writing on the wall, and I wanted to be first. Building the best technology in the world for traders was one of the coolest things anybody could ever do. I loved every second of it.
Thinkorswim will always be my baby, but this one, it's different. We built ours literally from scratch. It's a much thinner, it's a faster, it's a slicker application. Everything's on one page. So you're always looking at the core page and then bouncing around from there to get to whatever you want to get to. Most of our competitors have legacy technology, and some of them are multiple firms. Their technology has just been rolled up into a single platform. That's not the best way to build a platform. We built ours literally from scratch. It's from the ground up, so we were able to design it in the way that we wanted to design it with the flexibility that we wanted. And obviously beyond that, we do have, in my mind, the greatest customer service in the industry. You want to reach out to me, you want to talk to JJ, it doesn't make a difference who you want to talk to. We're always available, and not only are we available, we look forward to your questions. We're here to support whatever you're looking to do. So you can trade stocks, you can trade options, futures options, crypto. We're agnostic to product. We have the tools that you need to be a successful trader.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
What is going on, everybody, and welcome back. I almost said today's assignment. Welcome back to the Bad Taste segment. Today's Thursday, got another day in the week left. But what's going on, Chad, Julia? How are we doing today?
Dude, I'm doing great. Chad, how's it going? Welcome, everybody. Yeah, no, I'm like still cold. It's still freezing in Chicago. But you know, what are you going to do? I guess I'm used to it at this point.
I know it's not saying much, but it's pretty cold over here in Florida as well. I don't know if you've seen, but there's been some snow in Florida. There's been some snow.
I have seen there's snow in Florida where you are?
No, not where I'm at. It feels like it, but no, it's a little bit, it's more colder relative to what it's usually like. And then I know I was looking at the news earlier today and it's looking like there was some snow on the shoreline and I seen some people playing in the snow on the beach. I'm like, felt like a fever dream. But other than that, that's kind of what's new over here.
Well, you're ready to go because you are from a place with a lot of snow, aren't you?
Oh, I felt like I was back home. That's what I thought it was.
I was going to say, in Florida, though, that's got to be, I'd imagine, like, the houses and shit are not really, like, designed for this kind of stuff.
Can't be. No way a lot of the houses are built. I know some of the, apartments, whatever it is, especially maybe people that have more of a loft style. I know the insulation is not going to be as it would as, like, a regular kind of apartment building. So I bet people down there are a little bit more cold. But other than that, no. It's really not too bad. Can't complain. But I did see the snow on the shoreline. I was like, that's insane. But
that is kind of bananas, yeah.
Yeah, it's bananas, no doubt. No doubt. What's new with you, though, Julie? What's new?
Oh, nothing. Just another day in the market, I suppose. I think I'm, like, about as flat as you can get for today.
Okay.
Feels a little weird. I don't know. I threw some positions on today. I actually did a post-earnings play in UAL, one of the sleeper builds, actually. One of the sleeper builds that was down almost 5% today. Otherwise, I threw on a position in gold. I had a position in USO. I don't remember what I did with it. Oh, that's okay. Theta traders, awesome to see you. Organic farming, big ups. Bad traders, awesome to see you here. Illinois wants our snow back. Yeah, we actually haven't been getting very much snow in Chicago, fun fact.
Well, I see where it went.
I can see where it went. We just misplaced it. Bob, Osborne, Lone, Emmett, awesome to see everybody here. Thank you guys also for joining us. But yeah, feel free to shout out what you guys have been looking at today. But we've had some like kind of big movers actually. Some big movers, some small. But yeah, in terms of my own positions, I threw on a GLD trade. This is 57 days out. It was a trades from the research team idea actually from like 2 weeks ago, but decided to move over to the 57 days today. And then UAL, I think that's all I added actually. Kind of quiet trading day for me in terms of adding and managing positions. But what about you? Have you been looking at anything interesting?
Yeah, I mean, it's been a little bit quiet on my end as well. But I mean, I've been looking at oil, the micros on oil, traded some options on the futures on there, put that one on last night before the bell, sold a strangle. The buying power is just really, cheap, if you will, when it comes down to selling undefined risk strategies in the options on the futures. So kind of been dipping my toes in there a little bit. And then simultaneously or right after each other, I then put on one in the micro NASDAQ as well. So I got a strangle going on in both of those, a little bit more neutral on oil and then skewed to the downside a little bit on NASDAQ. So I know this morning I was looking at the price action this morning and I thought my thing was frozen for a while. I kept rebooting things, doing that, but we really weren't moving too much. I know we moved a little bit out of the gate, but there really wasn't too much price volatility at least. But the strangles that I have on was able to capitalize on a little bit of that today. I've been trying to be patient and not take these off early, but we got some strangles on, and that's pretty much what's new in the portfolio, just really experimenting with those options on the futures. So never really done that. So I'm going to be managing it week in, week out and see how we can go about those.
Yeah, I've liked options on futures in the past. I think obviously like a bunch of other factors that you have to consider, but so I've kind of messed around with these in the past. I do like with the futures options that you do have that capital efficiency is an additional factor from that span margining, which is nice. And one thing that I like actually about these types of products, and again, you have to be pretty careful with them. I always go defined risk with these personally. But one thing that I like is that, back earlier in 2023, when we had kind of lower vol, some of the commodities actually had high enough vol to trade like options on them. So you had a little bit of juice in there. Obviously, the liquidity is not there for a lot of these. But with beans, even beans, you got an IVR of 44. Whereas if you want to get away from earnings a little bit more, ETFs are, obviously an option, but we're not seeing a ton of volatility across the ETFs right now. So that's kind of, I think, an interesting case for trading some of these commodities, but it's just a gigantic product. So I always size very, very small. I do like the span margining, but I always use max loss really as my effective VPR because it can, jump up to that, obviously.
Completely.
Really interesting volatility in here. Beans, what's up? I'm not going to try to pronounce your name. Thank you for joining us over on Bad Trader. That's an interesting case for that. We're seeing actually decently high vol in some of these, especially in some of these currencies, which I do not trade much. I don't know if you've ever touched currencies.
Not much.
I'm definitely not much of a fan. GC has scorned me a time or two. I've been scorned by the gold futures. I got a GLD trade on, decided to do that instead of GC. One thing that between GLD and GC, GLD liquidity is not bad. But for the baby trades, because the fees are a little bit higher on futures options, sometimes I'll stick with the ETF options if I know it's going to be a small position. I don't know if that's necessarily the right thing, but that's what I do.
No, I hear you. I know you kind of mentioned the liquidity on some of the options on those futures. I completely agree. I know primarily, especially with NASDAQ, the liquidity is lacking on that options chain. A lot of the times I'm going over just right to QQQ and kind of trading the ETF like you kind of just mentioned with the gold. So it's kind of one thing I've been doing. But I know you kind of, I noticed you had a lot of, you didn't really have any individual underlines. Is it kind of because upcoming earnings season, kind of paying attention to that? Or I hear you.
Hey, Mighty, it's awesome to see you. We got Mighty back over in Bad Trader Chat. Welcome to the party. What's
going on, Mighty?
The party's been a minute. Yeah, in terms of what I have I have IronQ. That's a single company name, and it's a dumb trade. It's a dumb trade, but we're still holding that. GLD, IWM, IBIT. And a lot of these are shares too, just because I didn't want the leverage going into inauguration day. So now I got a couple more options on. And UAL is a single company name, but this is a post earnings play. American Airlines actually just reported today, and they donked actually. I don't know if you have any airlines exposure, but American Airlines donked pretty badly, where GE stonked.
What's kind of the case with the rest of the airlines? Are they kind of following suit?
Airlines are kind of all over the place. I mean, I don't doubt that UAL maybe had a little bit of sustained volatility from American Airlines reporting earnings today. This one I think has been a pretty interesting one. I mean, it was down, 5%. Pretty big move today. Maybe with the rest of the sector a little bit. But just looking at the long term, man, this has just been obviously, past performance, future results, all those things. We want to take historical performance with a very big grain of salt, but just a very, really just, impressive rally since September, since August, in this name in particular. This one was kind of surprising to me, actually. It was one of the stronger performers in the S&P from a performance perspective, not adjusting for risk. And you can kind of see that here. So obviously some volatility in the last couple of days with earnings. But for a post-earnings play, especially again with some of the ETFs having kind of low volatility across the board, that seems like an interesting play. Where did my...
Looks like American Airlines. I mean, just in August, we're trading at a low of 910, and we reached a high yesterday of 1911. So I mean, over 100% gain in something like an airline in just a few months is a crazy move and a sleeper build nonetheless. But I know we were talking United Airlines, but they put in some numbers over the last few months.
Oh yeah, they have. That's for sure. And I was looking this morning because we were on trades from the research team. I'm like, what do I do? Not GLD or GDX. It's a little bit too cheap for some of the stuff that I like to do. I already had a GLD position on from last week, or that I talked about last week. XLU, I find kind of hard to trade. The spreads in there are rough. EWZ, TLT, I don't like trading bonds. Bonds and I are not on speaking terms. We haven't been for a long time. And then USO is in here as well. Some of that oil volatility, but all things considered, it has actually been in a range, even after this kind of crazy rally. I don't remember exactly what the strikes were. I think it was like 70, 73.90, something like that. But I'm going to revisit that one tomorrow. And the spreads on here are like not my favorite. It's not the most liquid in the world, but again, for getting, some volatility in a little bit more expensive ETF to avoid some of that earnings exposure, that was the one that kind of made the most sense to me. Down 1.5% today.
No, I think I had seen natural gas mentioned in the chat. Is that something you've been keeping an eye on as well? I know it's kind of, I want to say similar to oil, but I know from a visual perspective, it looked like it was following oil a little bit there.
Bro, I have my saying with natty gas, which is that you either love it or hate it. It's like tequila. You either love it or hate
Based
it,
off
depending
of how
on
you
college went.
That's good. And just how you said, bro, yeah, it doesn't seem like you're too fond of natural gas, Julia.
So, just love-hate relationship. Here's the thing. The couple times that I have traded natural gas, and I do not touch this a lot because the volatility in this thing kind of speaks for itself. I don't touch this an awful lot. But when it moves, it really moves. And the few experiences that I've had with natural gas have actually been kind of positive. Obviously, volatility in there, but I've actually, had a good time trading it. But it's very love-hate relationship because you'll just randomly get one of these, crazy moves and crazy jumps.
Yeah.
And the options on here are actually, you have a decent amount of open interest on some of these options. It's just sizing can be a little bit tricky sometimes. But just to get some of that natty gas exposure. But yeah, I don't know. Love-hate relationship with natty gas. I've noticed from talking to more and more traders.
You know what? Grumpy might be onto something. Tequila futures, Julia. Tequila futures. Run.
Tequila futures. Did you? Okay, and someone can fact check me on this, but somebody actually at a show, at a Tasty Live show, mentioned that there are cheese futures. Did you know that?
Cheese futures.
Cash settled cheese futures. I'm pretty sure they're open for 15 minutes a day or something. Cash settled cheese futures.
Cash settled cheese futures. CSCWOO 179 right now.
Cash settled cheese futures. CSC equals F. I'm pretty. I don't know anything about this product. I just think that it's funny that it exists. I'm very bullish cheese, and I swear to God, I think they're open for not a long time. I thought I remember reading that they're 15 minutes a day or something, but either way, they're not open for a very long time. There you go. What's CODK? KODK. What is this?
The camera company that was kind of popping off like a meme coin at one point. I think that was a few years ago, 4 or 5, maybe now years ago.
Kodak. Fox. What in the world? What in the world happened in November? Everyone's just taking pictures.
Zoom out a little bit on Kodak. Kodak, I could have swore was the one that...
Was this a meme? I don't want to say meme stock, but...
I believe it. Yeah, there we go.
Yeah, what happened in June of 21?
Yeah, about 4 years ago now. I know what happened there. What was it related to? You know what?
What?
I could have sworn, someone could fact check me on that, but for whatever reason, I think Trump was saying something about Kodak around that time, and it turned it into some type of small cap meme, whatever, for the day. And I know it was kind of just going crazy, if my memory serves me correctly, but I believe there was some type of outside influence when it came down to Kodak.
Meme Stocks wants to know about Kodak. Has 1.4 billion in cash with a market cap. What happened to Kodak? Why did I miss this essential piece of history?
It reminds me of Hertz, like the Hertz company.
Yeah,
it's
like
Hertz it started popping off like a meme, and it's like these legitimate companies are this down bad or in a phase right now to where they're being moved as if it's like another GameStop or AMC. So it's always crazy to see.
Maybe that's why whoever's spamming it in chat is spamming it in chat. I don't know. But that someone says they might have said crypto. I think they said crypto from loan. I don't know how true that actually is. But do you know what that reminds me of a little bit?
What's that?
Do you remember when Radio Shack very briefly became a crypto exchange or offered crypto exchange services? I remember that. You got it. I had to go in the Wayback Machine to find it, but there was a time when Radio Shack just went a little wild on Twitter and started offering crypto swaps or something.
I could have swore. Does anybody remember what's his name? That guy. You guys see, this isn't the books in my garage and my Lamborghini in my garage. What's his name? I believe he purchased Radio Shack, if I'm not mistaken, and tried to do something and wrap it in the crypto industry. You know what I'm talking about?
You've described a lot of people. That is not very.
He was like one of the pioneers of it, like early 2013, 2014. Dark hair guy, glasses. What is his name? I forget if anybody remembers, but I believe he was the one. Yeah, I believe he tried to rebrand Radio Shack. What is his name? It's gonna bug me, but if anybody knows what I'm talking about, let us know in the chat.
2020 bump was from that. Actually, that sounds about right. Yeah, that's the guy with the face. That sounds about right. Oh man, yeah, I forgot. Now it is kind of ringing some bells. You know what's funny is like, wasn't this around the same time, like within a couple months of GME? Because like that kind of
I believe so.
That kind of drew a little bit more of my attention, to be honest. What a dumb trade. This is one of my worst trades with G. Look, it's still trading at $28. That's crazy.
Wait, what do you? GameStop. Oh, GameStop. I thought GameStop was changing something fundamentally with the company. That's what I heard. But maybe that was a lot of, I don't know, maybe the bag holders were printing out those PR news to try and get this up a little bit.
Hey,
I don't know what's
liked
going on
Radio
with
Shack
GameStop
when I was a kid because they have components. Best Buy doesn't have the same kind of components that Radio Shack had.
You know why I liked Radio Shack? And this is a technology that I fell in love with as a kid. I loved walkie-talkies. I don't know why. I loved walkie-talkies. It was so fascinating to me, and I still want like a super high-quality walkie-talkie to this day. But that's why I liked Radio Shack, because I remember we would go in there. They had all the walkie-talkies and the different types of technology that they had. I think that's why I like Best Buy, too. I think technology is just really cool. So maybe that's what it is.
You know what my favorite one is Micro Center. Micro Center is my happy place.
Oh, okay. I did say PC, so I'm gonna let that answer fly.
Yeah, I think you got half points for that.
No, I went to Micro Center one time. Yeah, if you like PCs, you're into PCs. That is like your Disney World. That's your Disneyland.
Lopez. Is it Ty Lopez?
Yes, it's Ty Lopez. Yes, Ty Lopez.
You got it. Hell yeah.
You know what I'm talking about? He was like one of the first guys marketing like that on YouTube. Like, you see all these books. You know what I love more than my Lamborghini? He goes, books. And like that started the pioneer of gurus left and right.
I remember Ty Lopez. Man, I can't believe they got that. Yeah, the guy with the face and the cars in 2013. That's crazy, dude.
Yeah, the guy with the two eyes, the guy with the hair. Yeah, him.
Awesome.
I believe he did do something with Radio Shack, but I don't remember how true that is. But I think he had something to do with it.
Dude, that's wild. I cannot believe. I remember Ty Lopez too. Did Ty Lopez buy Radio Shack? Can someone please fact check this?
Yeah, what does he have to do with Radio Shack? What is his?
Did he really buy Radio? Crypto doesn't own Radio Shack anymore. He bought Radio Shack in Pier 1. I never knew this. Oh my God, this is lost history. Oh my God, he sells off Radio Shacks and other. That's crazy. Radio Shack is under new ownership again. Executive Chairman Ty Lopez announced that he was selling the company. Yo, that's crazy. I had no idea. That's why Radio Shack went the crypto route?
Yeah, because of him. He was trying to rebrand it for whatever reason into the crypto realm.
That is crazy. Man, all the pieces, they're all coming together. Oh, yeah. Bananas. Okay, y'all. Well, we do have just about 10 minutes left. We got a whole bunch of people in chat. It's awesome to see you guys here. All the, a bunch of bad traders over here, which has been super cool. So we have a couple trivia questions. We can try to do a tradle. I have mixed feelings about today's tradle. I took a peek. Do you want to hop into it, E?
Yeah, let's do it. We got a couple trivia for the day. What would the theme be? The theme is going to be, again, fun facts. Stock market related, but fun facts. And I guess we could put it under regulation. We can do that, but hopefully we have time to get to the tradle. I'm still thinking about the Fiji answer. And again, Emmett Morrison, I will never forget you because Emmett threw Fiji in there. We got the hole in one, but let's get into it, Julia.
I'm going to be honest. This might be a similar situation.
Okay.
I think you'll immediately see what I'm talking about.
Okay. We'll get to it.
Not just crypto, AI crypto from Theta Trader. Hell yeah. Okay, guys, let's get into it. First things first, we do have an app. We've made a couple of cool updates, a while back, actually. Got to update this slide. But if you want to come hang out with us, we would love to have you. We got the tastylive app in there. We got batters and points and trading, which is kind of cool. Or linking up to a brokerage account, I should say. So if you want to come find us, it's over on the App Store and the Google Play Store. And then in addition to that, if you want to come chat with us, you can find us over in Bad Trader Chat. I will award you Bad Trader points if you get the correct answers to our upcoming trivia questions. Or you can come chat with us on Tasty Live's YouTube channel at Tasty Live Show. So, fun facts?
Fun facts.
Let's do it. Okay.
Facts you might have not known.
I might not know these facts. Let's get into it.
All right. What is the term alpha referred to in trading and investing? We got a few options here. We have the ratio of a stock's price to its earnings. Let me get a better visual on this. The ratio of a stock's price to its earnings. We got B, a measure of a portfolio risk-adjusted performance relative to a benchmark. We got C, the difference between a stock's high and low price in a session. Or D, the percentage of short interest in a stock. What is this? This is a term that I've seen flying around in the trading community. I'm like, what does this mean? Why is everyone using this term? I felt like an outsider for one of the first times when it came down to markets and on social media and online. But alpha is a term that might be a little bit more familiar in crypto.
That's, it's also, so I do hear a lot of people like, seeking alpha, even like the website. And a lot of people are talking about alpha. It does also have a mathematical definition related to beta. Mm-hmm. Fun fact. Maybe someday we'll do a big old dive about it.
We got to.
But let's
What do we
take a
think
look.
in chat?
What is chat saying over here? Seeking alpha. A bunch of people know their stuff. We got Bob and Big Teal Donuts back over in Bad Trader Chat. It's awesome to see you guys there. What does the term alpha refer to in trading and investing? Could it be the ratio of the stock's price to its earnings, the measure of a portfolio's risk-adjusted performance relative to some benchmark, C, the difference between a stock's high and low price in a session, or D, the percentage of short interest on a stock? Although admittedly, all of these metrics seem pretty interesting. But which one's the alpha? What could it possibly be?
It looks like we have a pretty common answer. It looks like this was a softball, apparently.
People definitely know their stuff over here. A bunch of people are saying it. So I'm going to go ahead and I'm going to echo what people are saying. Could it possibly be B, the measure of a portfolio's risk-adjusted performance relative to a benchmark?
Let's check it out. B, measure of a portfolio's risk-adjusted performance relative to a benchmark. And then we got a little bit of an explanation. But alpha represents the excess return of an investment compared to a benchmark index, and it shows how much a portfolio manager or strategy has outperformed or underperformed the market on a risk-adjusted basis. Positive alpha indicates better than market performance. But again, another term heavily thrown, especially with Gen Z. Gen Z loves this word alpha when it comes down to the crypto industry. So if crypto starts getting a little bit more popular again, maybe things start popping off. I know Ryan Grace is doing a great job educating people in the crypto realm. Alpha is something you'll see very commonly. But we got the first one for one.
And people seem to know their stuff. Looks like Bob got it, Organic Farming got it, Theta got it, T-Port, got it.
Apparently I'm the boomer because
a whole bunch of people got it. Looks like, Bob got it over in Bad Trader Chat as well as Big Deal Donuts. So y'all are getting some trivia points for that for sure. I'm going to go ahead and divvy those out. And then for the next question, what do we have?
Let's do it. Number 2 on the day. Who is considered the father of value investing? I should have put Tom Sosnoff's name on there, man. Anyways, A, Benjamin Graham, B, Warren Buffett, C, Peter Lynch, or D, John Bogle. Who is it?
What could it possibly be? Don't feel bad, Unc. I saw your tweet that you got called Unc in a Discord chat.
Oh, goodness gracious. I did. All right, but hey, look, I could. Big Deal was there as well. Big Deal said something, and they didn't call Big Deal Unc. They called him something else. So I'll take Unc.
Oh,
no,
God.
Anything past 25, everybody under the age of 25, if you're 25 and up, they think you're like headed for retirement. Like they don't even think they think you need a
retirement home.
Legitimately, though, yeah.
Which is like, they're not too far off. I'll just say that.
No, they don't understand. I'm like, you guys will be here in any second now. I said the same thing when I was your age, and it literally just like that. So keep on laughing. Keep laughing.
Just keep laughing for now. So you already sound like an uncle. So there you go. All right, chat. We have a pretty consistent responses over here as well. A bunch of people are saying Benjamin Graham. Warren Buffett was another guess, but he did a different type of investing that right? Doesn't he do No, but does he do? Actually, I don't know what Warren Buffett does. I don't follow most other types of investing. Actually, I know what they are. This one I do happen to know. Does Warren? This one I happen to know, and it also seems to resonate with what people are saying over in chat. We got a whole bunch of people in Bad Trader Chat that got it right as well. Could it possibly be A, Benjamin Graham,
Could it be Benjamin Graham? I thought we were going to get a lot more Warren Buffs thrown in chat, but we'll take it. Benjamin Graham. Yeah. Benjamin Graham, the author of The Intelligent Investor, probably one of the most popular investing books, I would say, in security analysis, developed the principles of value investing, emphasizing buying undervalued stocks with strong fundamentals and margin of safety. But it is Benjamin Graham. We went 2 for 2 on the day, and that lets me know I'm going to have to turn it up a couple notches when we hop out next week.
There you go. Okay, Steve got it right. Buffett is a student of Graham. I thought he did value investing, but I'm like, did he do fundamental invest? No,
I did not know Buffett was a student of Graham. Okay.
The last 3 were all students. So there you go. Theta Trader should get extra points for that one. But I'm going to go ahead and award some points for bad traders over in chat. Well done, guys. You get 200 points for knowing your stuff. And do we want to? We got 3 minutes left. Do we want to try to do the tradle?
Let's do it. I think we can get it.
Hell yeah.
Feeling good.
Theta Trader, I feel like you get extra points because you knew they were all students of Benjamin Graham. So I'm going to go ahead and send those over to you. Hell yeah. It looks like it's about time for our tradle. This is, I think, maybe the first. Is this the first one that we've done together in 2025? Or have we done one before?
I think it might be. It's been a little while.
It's been a hot minute, that's for sure. So if anybody is joining us for the very first time, we like to play a game called Tradle. It's similar to Wordle. A little different, though. We're given the export distribution of a country, and we got to figure out what country it is. So this country, 96% of their exports are gold.
Okay.
The total amount of exports is about $7.5 billion. We got some other stuff in here. We got like raw cotton. We got oily seeds. We got, oh God, that's how much we got.
None of that matters, though.
Rough wood.
We got gold.
It's 95% of it is gold.
Everything here is made out of gold.
Evidently. 96% of their exports are gold, and it amounts to about $7.5 billion in exports. So, I mean, it seems similar to the water Fiji situation. Do we want to try to one-hit this?
Let's do it. Julie, what first comes to mind when you see gold? Just 96% gold. What first comes to mind?
Okay, so when I see gold, I'm like, it could be Switzerland because Switzerland does a lot of gold, but that's not 95% of Switzerland. I think like Ghana, like maybe somewhere in Africa.
Right, where they do a lot of
South Africa
mines.
I
say we start somewhere. Go ahead.
Well, I was going to say, I don't think it's South Africa because De Beers Diamonds is based out of South Africa. So I would expect diamonds to make up a pretty big chunk of South Africa. It could be that, though.
Valid. It's valid.
Damn, who does so much? It's so much gold. It's like...
There's a movie with Nicolas Cage to where they find this one room at the end of a movie and it's just like pure gold, wherever that is.
Someone's asking, are diamonds on the list? I mean, man, we got iron.
Iron core?
Manganese. We got thermostats. It's gold and thermostats? That's bananas. This is too small. Newsprint? Yeah, dude, I don't see... If diamonds, they might be on here, but I do not see them. So I'm very skeptical that it's South Africa. You can't go south. Eritrea.
Africa's got to be more diamonds.
Got to be more diamonds.
I think Blood Diamond. That's a really good movie. If that's what it's called, I think that's what it's called, though.
Peru. I would expect like alpaca wool to be more of an export if it was Peru. I love alpacas. Okay, so Madagascar. I think of vanilla. Okay. Let's just start with something so we have a jumping off point. How about that?
Okay, what's the best answer besides, I watch it be Africa or South Africa, but what is the best answer besides that? What are we thinking?
I like Eritrea.
Eritrea. Let's throw it in there.
Let's see. Okay.
We're
77% of the way there, and it's straight west. It's like directly west. It's 4,600 kilometers west.
I'm not sure where Eritrea is.
I'm also not sure where Eritrea is.
Okay.
I'm trying to think, I'm going to try Ghana, actually.
Let's do it.
I'm going to try Ghana, because it could be on Okay, it's very close to Ghana. It's very close to Ghana. So
right
we're
above.
94% of the way there. It's straight north of Ghana.
North of Ghana, guys.
Now it's more of a geography problem. It's not Switzerland. Switzerland's a lot farther from Ghana. It cannot be Switzerland, guys. I promise.
Switzerland
there's no
is
way
a hot
Switzerland's
topic in
not north
chat.
of Ghana, is it? Am I like losing my mind?
Let's satisfy the chat with throwing in Switzerland.
It's not
Just to
Switzerland.
see.
There's
just
no
to
way.
see. Just to see.
Okay.
It's
not going to be Switzerland. If it's Switzerland, I will eat my hat.
As long as it's in the 90s, as long as it's 90-something%, I'll take it. Just to satisfy our curiosity.
See, it's not Switzerland.
Okay.
It's south of Switzerland.
Guys,
We're
I
further
told you
away.
it wasn't Switzerland, guys. I knew it.
Okay, organic farming. Because see, now I'm trying to remember. Because like Ghana and like the Ivory Coast, they're all kind of, it's a bunch of small countries that are kind of clustered together right on the like the western, northwestern, that kind of dip on the African continent. Oh, I'm going to go nuts.
How do you feel about Egypt?
Mali? Why do I feel like Mali? I could try Mali. I don't know. We got 3 guesses left, so I guess we got some room. I'm trying to, what about like, north of Ghana. It's north of Ghana.
Okay.
I thought the Ivory Coast was like east of Ghana. I'm losing my mind. It's one of those, Okay, let's try Mali, because a bunch of people are saying Mali, but you guys also said Switzerland, chat. Mali?
Why are you bringing up old stuff, Julia? Why are you bringing up the past?
It's Mali.
Let's go. Okay.
Mali.
Didn't know that.
That's where the golden geese live. They're all in Mali. 96% of their exports are just gold. That's crazy.
Just gold. Yeah.
Hey, well, chat, I'm honestly really surprised. I thought we were either going to like one hit it or not get it at all. I think we got it.
I mean, if they run out of gold, they're cooked.
Yeah, right?
96% of them is relying on gold. That's crazy.
Yeah,
but
dude.
Good to know. Fun fact of the day.
Yeah, man. I don't know.
Yeah.
A bunch of people said it. A bunch of people got it right. Looks like Emmett got it. A bunch of people backed the Mali choice. I don't know who got it first, but Bahumbug, that's a great name. I think they might have said Mali first. But we got it right, guys. We did it. We finally got our. I'm just gonna make sure don't need to give out points in Bad Trader. Nope, we're good. Okay. Well, we got it, guys. Well done. Is there anything that you want to leave on? Anything that you want to say?
No, that'll be it. That was a fun one as always. Thanks for taking the time to hang out with us, and we'll see you guys again next time.
Cool. Awesome. Thank you guys so much for joining us. Thanks for participating over in chat. We will catch you guys later. Good luck trading. Peace.
Know someone who needs a better broker? Earn $250 for each qualified person you refer to Tasty Trade. Because friends don't let friends trade on a bad platform. Terms and conditions apply. Join the club, genius. Tasty Trade.
If you missed the live show, here's our cherry on top weekly recap.
My favorite time to read is when I'm away on vacation. I'm on like an island somewhere and I have nothing to do except sit under a hut. That's my favorite time. But I don't see that happening anytime soon.
You believe this shit? The favorite time you like to read is when you're under a hut on an island. That's pretty specific.
In the world of options, somebody once said, for every gimme, there's a gotcha.
It's all about generating positive expectancy in your portfolio.
Welcome to Option Trades Today. I'm Tony the Bat Batiste, and I've got not one, but 2 trade ideas for you today.
Exploring zero DTE. We promised you we would take a look, and here we go.
All right, yeah, I'll talk to you. There she is. Good, you found the place. Good, you're not stupid. I dated 3 stupid girls in my life. I loved every one of them. So maybe you're the next one. Having a good day? I'm having an awful day. But then it got really good again. Oh, good. So I'm feeling all right. Hey, where'd you go to college?
I went to
University of Penn State Community College. You didn't know they had one of those, did you? Yep, the Fighting Rams.
Oh.
I'm one of the Rams now. Do you have any sexual fantasies?
Excuse me?
I do. My parents are watching. They're sitting on a rainbow. I'm a half man, half giraffe, and I'm dressed like Brett Favre. What does that mean?
I don't know.
Yeah, talking about it gets me pretty hot, though. Uh-oh, there it is. His pants just got tighter. I'm a vampire. Can you believe that? Does that make me more mysterious and attractive?
What?
Uh-oh, watch yourself. We don't want to get hit by a car. My brother did that once. He can't talk now.
Oh, my God, I'm not serious.
Yeah, pretty serious. Are we getting serious? I think so. How many kids do I want? 5? 11? First meal. Here we go.
That was rude.
This is on you. So much time is flying by.
Yeah.
You're very funny.
Oh, thank
Does anybody
you.
ever tell you that?
Yeah.
Well, you're not that funny, so don't worry about it.
That's interesting.
Not a big fan of Sam's anymore. But now you know everything about me. I feel like I'm opening up so much. God, I'm scared. This thing's moving so fast.
Yeah.
Oh, wow. I haven't cried like this in a long time. Are these tears? Uh-oh, here we are. Front door. Big first kiss moment.
Oh.
This is just moving a little too quick for me. You're a great kid.
Look who's back testing. tastytrade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at tastytrade.
Don't screw up. You're the weakest link here.
You guys introduce yourselves.
I'm Tony Batista. He's Tom Sosnoff. You didn't know that? I don't have any idea why you watch.
I'm Tony Batista. He's Tom Sosnoff.
41, you got it.
See that? We knew it. Pretty good. Baseball field.
Baseball game.
It was a wonderful evening.
It was a warm summer day, 1982.
It was around
82, 83. I don't know, sometime around there.
Yeah, 83.
83, let's say.
It was 83. I remember because I was dating somebody else at that time. 1983, yes. It was a wonderful day.
No, we were playing. We played softball on the same team.
16-inch?
12-inch.
With gloves. Because we were hand models at the time.
Yes. I played third base, Tony played right field.
You've been dying to say that, haven't you?
We took him to use a charity case.
How much does it cost you guys to do simultaneous hair flips?
Years of practice.
Everybody wanna be like me, yeah.
In the world of options, somebody once said, for every gimme, there's a gotcha.
It's all about generating positive expectancy in your portfolio.
Welcome to Option Trades Today. I'm Tony the Bat Batista, and I've got not one, but two trade ideas for you today.
Exploring zero DTE. We promised you we would take a look, and here we go.
In the world of investing, a beast lurks between the numbers, ready to pounce. Some traders hide from it, some ride it. If that's you, join us on Tasty Trade. Genius loves company.
Look who's back testing. tastytrade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at tastytrade.
Oh, yeah, it is
Thursday, January 23rd, a little bit after 5 p.m. Central Time, the best time. You know what that means? It's time. It's time for Tasty Live's evening show, a little podcast called The Price of Truth. A little podcast called The Price of Truth, the show where we like to explore the incentives that govern our world. And it's sort of interesting that I would call this week the week of incentives. All they're throwing out is a bunch of incentives for us to chew on, incentive structures for us to go through and figure out how does this impact anything, much of which we already knew months ago. But nonetheless, a fairly active news week. But before we get to all that, wham, bam, and thank you, ma'am, we should say what's up to each other. That's how civilized people interact. Let's say what's up to all the people watching on tastylive.com, as well as all of you watching on Tasty Trade desktop and mobile applications. If you don't have both already, go get them. But if you want to be part of the conversation and get your name and comments, both appropriate and otherwise, somewhere on the screen, bing, that just popped up. Did that work? Was that well timed? Probably not. But if you want to be on the screen, there's only one place to do it, and that's on Google YouTube. So head on over to the evil, but soon to be reformed Google YouTube, and jump in the chat. Introduce yourself to some of the finest people, I would say, in this corner of the internet anyway, and be active in the chat. Get your phalanges moving, smash your face on the keyboard, throw it out of a window, do anything that keeps those keys moving and the chat active, because you will spoof Google into putting this show in front of as many people as possible. They don't really know what we're talking about here. I know they got fancy AI algorithms that are parsing my words in real time, trying to figure out, is this person crazy? Is he talking about things that he shouldn't be? And how do we either demonetize this person or make sure that no new people come in and listen? But the more you're active in the chat, the more new people will see, and we can save the world one view at a time. Speaking of the people, by, of, and for the people, we should say what's up to the people. Shout out to everybody that's already in the chat, working those phalanges. Lone, Theta, Grumpy Mike, all the regular cast of characters here. Dav, Ben, what's up? Yo to you, Ben. Katan, Aaron. one of the best of their sketches. Victoria, how are you? Great to see you. Chris Connolly, what's up, Tasty Nation? What's up? Back to you. Am I part of Tasty? I never know how does that work? Does Tasty Nation? Can you only be a part of Tasty Nation on the outs, if like externally? Are the internal people a part of Tasty Nation as well? Because I want to be in the club. What's that quote though? Any club. I don't want to be a part of any club that will have me. What is that? Groucho Marx? What is that? Catan, how are you? Jason Tatum, Theta, Max Virtuous, Osborne, so many. Look at you guys getting active. V-Dub, Damon, Leroy Jenkins. You guys are nuts. Brian Watson. Brian's a low-key the YouTube champion, like the YouTube king. Everyone give Brian a big thumbs up for putting in work with his timestamps. One of these days, I'm going to put out individual videos on an individual channel, and I hope Brian will be a part of that community, because God knows he's doing God's work out there, people. Shout out to you, Brian. All right. I would love to just finally put him up on the screen. We got to get that timing up, you know? That's my fault, though. I'm late, and the producers are like, God, I hate this person. All right, let's get going. Let's throw that platform up on the screen. Everybody, S&P 500 today up 0.5%. NASDAQ, the laggard, up 1/5%. The Dow Jones up nearly 1%, and the Russell up 0.5%. It's been sort of weird. It's been sort of the market action has been, I want to say sort of weird. Use better adjectives, Victor. It's been hard to track, meaning there's no real consistent theme on a day-to-day basis. The theme is generally to the upside this week, but there's been no consistent theme. There's no value outperforming growth. There's no large cap growth outperforming value or small cap or mid cap. There's been no real rhyme or reason to asset movement
as sort of a theme that's played out this week, at least to my eye. I don't know why I'm so, I'm so stuck in a world of pattern recognition. It makes my brain calm down. It makes me feel like I can deal with the randomness of the world if I can find some sort of pattern that repeats over and over. And when I can't, I make note of it to the others. Not that it's necessarily impactful to your trading. The point is, sometimes we'll get these periods where it's like clear that there's a value over growth or large cap over small cap, or let's say Dow Jones outperforming. I don't think there's necessarily been a key theme. Every time we come in here, we talk about a different index, a different major outperforming. So I don't know. Rising tide lifts all boats, I suppose, over the last couple of days. And man, I think we've emphatically broken out of that little channel that we were talking about. Right here, I came on this program and said I like the risk of reward of fading the strength. Good call. Good call. But it didn't work. But the idea, I think, was the logic was okay. Right, that if we could get a break here, likely we could see some extreme volatility given the setup. We just didn't see that. I think the markets liked a lot of what they've heard over the last couple of days. I think they liked the lack of volatility, the lack of retaliation here over the last couple of days. I'm not chasing them here. If you are, God bless. But more on that in a little bit. After hours here, they're fading a little bit, but I don't think that's going to mean much. Why? Because VIX cash, we're at 15. What were we yesterday? 1560, something like this. So we've floated down a little bit by a few cents. But VX/VX, so volatility futures are at 1650, are not really doing much. So vol at least doesn't care about this little fade that's happening in the extended hours, the last 18 minutes or so. What a day, my babies. What a day. Bonds 112 and 29 30 seconds. We've come off this little sort of, I swear, bonds moving like 3 points. If they want to rally them, we get like 3 points to the upside, and then that's about it. They look like they've rolled over the last 2 sessions or so. Speaking of bonds, let's take a quick look. My babies. Let's take a quick look at the yield curve here. If this is the first time you're witnessing this, I try to do you guys a solid. I'm a visual person. So I try to do you guys a solid and show the yield curve, which is basically all the maturities in the short term out to the long term maturities, and you just show it visually. So when you look at the platform, and I love the platform, don't get me wrong. First of all, when you're looking at ZT, which is the 2-year, ZF, which is the 5-year, ZN, 10-year, and ZB, which is the 30-year, then there's the Ultra Bond. If you don't watch those, first of all, those are bond prices, not yields. So just the idea of converting those from bond price to yields, which you can't do in your head, if you're not watching those, it's hard to sort of understand what might have happened. So just first and foremost, converting these to yields, and then secondly, showing them visually, I think helps tell a better story of what's happening with interest rates. So I try to do that early and as often as possible, because I do think interest rates are very important to asset prices. And I think many, I don't know why, but many in the equity space, I mean, you could listen to somebody talk about what they feel, what they think stock prices will do, and interest rates will never even come up, even though it's like a foundation of a capital asset pricing model. It's the basis of everything. And 2022 showed people, if you don't understand interest rates, you're going to get hurt. There were so many people that didn't understand when you lift the Fed funds rate off the floor from nothing up to 5%, that has a material impact into how you should think about assets across the board. And I think it exposed a lot of people for not knowing just the extreme basics. Can you get away with that? Sure, probably. You can just look at a chart, look at technical analysis, listen to some newsletters. Could you get away with it? Probably. But I think at its base level, there's a lot of do-it-yourselfers here, right? Can we buy kombucha at the store? Yeah. Can we make it? Yeah, let's give it a shot. Can we buy pizza from, I don't know. I'm not going to get in that argument with the Chicago and New Yorkers. Can you buy it? Sure. Is it fun to make it every once in a while? Shout out to Tony Batista, who I think just posted him and his wife making a beautiful looking pizza. Yeah. The point is, we got a bunch of do-it-yourselfers here. And we can understand what's happening at the root level of the cost of money, which then have implications into how we think about everything else. Anyways, get off the soapbox here. The red line is what the yield curve looked like when we started this whole silly interest rate cutting back in September. The green line is the second. So in September, we made the first 50 basis point cut. The green line is November when we made a second cut, which was 25 basis points. Blue line was December when we made the third cut of 25 basis points. And the last one is effectively today. And you can see what is happening is the short end of the curve is going down. As the short end of the curve is going down, the long end of the curve is lifting. So what's happening is we're steepening up the yield curve with each one of these cuts, which I think surprises a lot of people. Luckily for us, it didn't necessarily surprise us. You get some things right, get some things wrong. Vic and Tony's Pizza Shop. That was, by the way, he has the slickest way of doing like these underhand like these little jabs to the body. Like that it was a slick little way of saying like you guys should be doing that. You guys shouldn't be in this business. You guys should be over there making pizzas. He's slick. But the point is, we are seeing a steepening up of the yield curve, and I would suspect. You can sort of see the second point on the yield curve here, right? So what's happened as we've started cutting these rates, we had some points of inversion. What do I mean? Well, here, before we started cutting, the 1 year was telling you, or was trading at 3.99, where the 10-year was trading 3.71, meaning you were getting paid more to lend money for a year than you were to lend money out 10 years. And normally that doesn't happen. A normal yield curve is, if I lend you money for a longer period of time, you're going to charge me, or I'm going to charge a higher percentage for the loan. So as you go out in time, you should see higher rates out in time. There's more time for the loan, more things could happen, more opportunity for the person not to pay it back, or more time for inflation. So even if I do get paid back, the purchasing power of the dollars I'm getting paid back in it doesn't have the same purchasing power. So normal yield curve, we should see rates higher out in time. That was not the case when we started this whole thing, meaning we had an inverted yield curve. Shorter dated maturities had higher yields than longer dated maturities. That's not normal. As we went through this cutting cycle, as you've seen, the shorter end rates, which the Fed really has a tighter control over, they start dropping rates. So the shorter end is going to come down. That helps ease the yield curve inversion. But as they're doing that, they're putting less pressure on growth and inflation. And so that your long end starts to come up a little bit. And we're headed towards a more normalized yield curve, whereas you go out in time, in this yellow lines, you go out in time, you're seeing higher and higher yields. That's sort of a normal world. And the only thing that is not normalized is sort of this very short end front kink. And the only difference now, whereas we had huge differences back then, the only difference now is maybe 25 basis points, 25 plus basis points, which means the market probably has settled out to maybe 1 or 2 cuts within the next year, and then you're probably going to have a normal yield curve. And then the cutting cycle likely is probably going to be over. And, the this whole game is over, and then we hit a reset button. Whether we need to go lower, we sit, we need to go higher, but that's likely sort of where we're headed. And just really quickly, I'll throw in some of these the CME stats. I like to use the CME FedWatch tool. Most people that go to this, and you can just Google it. I gotta stop. I gotta figure out a new phrase for that. But you can, what should I say? You can DuckDuckGo this. It doesn't roll off the tongue. You can DuckDuckGo Fed or CME FedWatch tool, and it'll bring you straight here. But the point is, I really like this tool because it'll give you sort of the probabilities of how the market is pricing in Fed funds futures and what that means for the probabilities of a rate cut. But most people sort of use this current tab. I like to go to aggregated, and it gives me a fuller picture of how the market is pricing the implied probabilities of each of the meetings out in time. So basically, this January meeting that is coming up, is that next week, January 29th? Nearly 100% probability they're going to hold. They're not going to do anything. In March, there's a 73% probability they're going to hold as well. And then in May 7th, it's a 50-50 shot right now. So you got a 50-50 shot. And basically, by June of this year, the market has priced another cut. There's some wonky things happening in the data, or likely this is illiquidity. But then you have a pretty decent probability of one additional cut sneaking in here by the end of the year. So somewhere between 1 and 2 cuts for the rest of the year is how to likely think about the current consensus for how or what we're going to see out of the Fed and what we're going to see happen to the short end of the curve. So what happens to the long end of the curve? I think that's really likely going to focus or center around, obviously, growth and inflation. So the Federal Reserve, they own the short end. Growth and inflation and people's expectations of growth and inflation are owned by the long end. So what the Federal Reserve has told people about growth is to expect 2.1% growth in 2025, to expect 2% in 2026, and 1.9% in 2027. And just for context, trend growth would be 2%. Bing that thing, bro. Thank you, Theta. That's probably better. Bing that thing. That is better. I don't know. The thing is, Bing is Bing still a Microsoft product? It is, isn't it? And if so, I can't support it because you're going to end up with the same thing as Google, just with a different set of incentive structures. That's why I sort of like DuckDuckGo a little bit better. But if we made DuckDuckGo as big, we're going to end up with this same problem. Anyways, so trend growth is 2%. So where are we? Well, if we go to the Federal Reserve Bank of Atlanta, they have something called GDP Now, where they crunch the numbers. I don't know, I'm a weirdo. And they basically spit out where we are right now with GDP. It's currently calculating the fourth quarter of 2024. And it has it as, so the GDP Now model estimate for real GDP growth in the fourth quarter of 2024 is 3% on January 17th, unchanged from January 16th after rounding. In other words, and this is again for the fourth quarter, but in 2024 the Fed had growth at 2.5%. That's probably close to what annually we're probably above that. So the point is they likely just slightly underestimated growth in 2024. And at 2.1%, the question should be in everyone's minds, are they underestimating growth in 2025? Or over, I suppose. If you see a recession on the horizon, 2.1% might seem too aggressive. But for the incoming administration, who likely is trying to achieve a 3% growth target, they've stated that explicitly as an economic goal. It will likely guide their policies. It might not have the impact into the real economy immediately, but it will probably have an impact into the financial economy. The point is whether or not the Fed is close on their projections and growth. And I don't hear anyone talking about that. I hear everyone talking about like the inflation side of this equation. I don't hear anybody saying, are they way off on their growth targets? And if that's the case, what would that mean for yields? Because really, you take growth and inflation. That's how you come up with your sort of back of the napkin 10-year rate. And I think, in a way, I was listening to some of the things that are coming out of Davos. I have to be careful, but some of that infuriates me. But the fact, Larry Fink said something. He said, I could see the 10-year Treasury yield could hit 5 to 5.5%. That would shock the market, and that would not be a good scenario. I think Jem Carson gave an interview. I didn't get a chance to see the whole thing, but I think he said something in the ballpark of that rates could get to 6% and that stocks could decline 30 to 40%, something like this. It was part of the headline. I was watching some of it, but I have a ton of time. I'll watch the rest. So if I'm taking it out of context, please go watch the interview. He's always worth watching, regardless of the network. So I think it was a good. The point is these 5 to 6% yields are now starting to become part of the market expectation, part of the consensus. And the last thing you got to worry about is whether or not they're right about inflation. They have 2.5% in 2025, 2.2% in 2026, and 2% out in 2027. Some part of me thinks that's probably right in 2025 or close to it. It's probably close to it. And I don't know. You need to see a big downturn, I think, to get us back to 2.2% in 2026. Even though, base effects are going to start to work in inflation's favor here pretty soon, and you're going to hear people squawking about that. I just don't see us getting down to 2.2% next year, but call me crazy. All right, let's keep cruising. The whole point is, okay, Victor, what are you saying? Distill this into something actionable. I like selling vol in bonds. I really, really thought the setup is here for sort of a long bond rally. It's just not there. And I don't know that we're close to a catalyst. So here's my thing. I've been telling people, I kind of like the long bond position. And the way I execute it is through ZB and ZN. I probably wouldn't tell other people to do that with their money. Not that I'm telling you to do anything, but if I was talking to other people, I would probably say if you wanted to put on a long bond position, probably use TLT and probably build an equity position. If I could go back in time, I think that's what I would say. Because while I'm okay burning my own money on this risk and reward, I don't know that I love the idea of talking to other people about that same idea. I don't know that I have the conviction in it. I think it's going to take some time to play out. And I don't know that we're close. I always thought where I was entering into a long bond position at, let's say, 4.7% in the 10-year, I thought I could be early, and I could be early by 20 to 30 basis points. I thought we could get to 5 easily. At 5, I think your risk is 5.25. The idea that we get to 5.5 or 6, I don't know what has to. Something's got to go horribly wrong in a very quick amount of time. And I didn't see that in the cards for the short term. So I thought my pain was like 50 basis points. I can stay small and withstand that. But I suppose if I take a step back and I think about like the landscape that we're in right now, and just the rhetoric coming out of Davos is wild. You know, let me read something to you. Let me read a headline of an article. You're more than welcome to go read this article. Here's an article posted on the World Economic Forum's website. Okay, this is the World Economic Forum's website. Again, they're holding their annual meeting in Davos, Switzerland. The article is titled "Soaring Public Debt is Worrying Experts at Davos 2025. Here's why most of us didn't see it coming." I'm going to read that again. Soaring public debt is worrying experts at Davos in 2025. Here's why most of us didn't see it coming. This is insane. This is like the level of insanity it would take to write that article headline and post it on the World Economic Forum. Like the gall, the audacity. These are the world's foremost economic experts. Let's be very clear. Our elected representatives, other than like Nancy Pelosi and her husband who are out there winging in video calls, I don't think many of these people could figure out what we do every day, let alone the complications of sort of national economics and sort of the entire globe's economy, especially as we navigated through these massive crises over the last 10 years, 15 years. So what these elected representatives do is they go to experts in the banking and finance world. They go to these people and they say, what do we do? What is your opinion? And throughout all of this journey of racking up all this post-COVID debt, do you want to know what the Federal Reserve Chairman was saying on TV every day when they were asking him, but what about all this debt? What about, isn't this a problem? Isn't this a problem? Isn't this a problem? And these aren't genius finance people asking these questions. See, they're just normal reporters. And what does he say? There will be a time to be concerned about the debt. That time is not now. Something to this extent, I'm paraphrasing. And all of a sudden, there's articles saying, oh my God, there's soaring public debt out here. We didn't see this. You didn't see that coming? Are you crazy? We have this little show on YouTube. And from the very start of this show, one of the only things we've been talking about is the level of public debt, both here in Japan, which had run this experiment for the last couple of decades, and what it did to their society, and every other Western developed nation with a central bank. You mean to tell me you have the audacity to post an article that says, oh my God, would you look at this? Like you're the foremost leading economic experts, and you mean to tell me you just woke up and read the newspaper and go, oh, did you see the national debt? Give me a break. Now that I got that off my chest, here's the point. The point is the supply and demand. I know people go back and forth on this. If you ask Andy Constant, I don't think he thinks that the supply and demand matters much to the yield. I have a hard time getting on board with that concept, but he's a big brain, man. I don't disrespect it. I don't call it wrong. I just saying I don't have the knowledge or the intellectual tools to get on board with the idea that supply and demand of debt doesn't impact the yield. And so there, we're in a time right now where we don't have quantitative easing, which means all of this debt issuance from our government and from all the other governments are searching for a buyer. To be clear, for like the last couple of decades, there's been a buyer, and it was a central bank doing nothing with it, just parking it. And now we're not in that funny money world anymore. We got to go actually find buyers for all of the globes, all of the developed nations that want to keep borrowing. We got to find a buyer, a willing buyer at a willing price. And so to me, I had two minds of this. And I'll say it again. I'll get off bonds here. I know I go on a tangent sometimes with this stuff, but I think if you get this part right, everything else is downstream from this. But trying to get everything else right, if you're not even thinking about this, to me is crazy. But to me, I had always saw, and you can check the tape. I said I think we're gonna head to 5% yields in 2025. I just am surprised with the trend in which we're headed there. Maybe I shouldn't be. I just thought just the natural feel of a market usually has more two-way action than this. But that's where you get caught trying to be if you like to trade both with the trend and with the counter trend. I suppose this is a pretty decent example of when trying to touch the oven, you can get your hands burned, or the stove. Being greedy and saying I want to trade the counter trend kind of hasn't paid for me very well. There will come a point, I think, where if we're going to head higher and higher, we're going to find that breaking point. Interest rates are going to find the breaking point for equities if we're not careful. And if we're headed to a world of 5.5%, like even anything above 5%, I think starts to get a little spooky. You're talking Larry Fink saying 5.5%, and Jem Carson, who I trust much more, even though he doesn't control gigantic pools of money, though he does have a decent amount under management. You're talking about potential of 6%. Those should be scary numbers that the equity market is not priced for. But I didn't see us going straight there, man. I thought we'd see some back and forth action. So, anyways, I like the setup here at 110 was great. We got a nice little rally to 113. At 113, I have to go back to my risk and reward. My risk and reward is on the upside, you get a rally back to previous resistance, which would be 115.20, which is 3 points to the upside. Your risk is you go touch 110 again, and perhaps the trend says you could go even lower than that. So you got 3 points upside, 3 point downside. In the very, very short term, I think it's a 50-50 call. So I probably don't love long deltas here. I don't hate them. I don't love them. But I do have a little bit of tiny long deltas here. All right, let's keep cruising. What are you guys saying? They're selling new Escalades, almost 200,000, no public debt. I don't know what people are smoking, honestly, when they're buying these vehicles. No idea what people are smoking. Vince K, at this point, past COVID, I've learned I have a better perspective than any expert out there. We all do. I think that's the right. So I'll pause for a minute. I like the direction you're taking the conversation, Vince. I would say that prior to that event, so the idea of specialization means I get to focus on what I'm doing, and I trust that other people are focused on what they're doing. And that in order for added convenience and in order for me to do more things with less, that I've got to do my thing and I do it well and I optimize it, and that other people are going to do their thing. And what I think that event taught me is how much trust is embedded in that system. That if I have a certain value system, I'm going to do my job and optimize in a way that says I want to bring more value to this marketplace. I'm going to do it with integrity and with honor I'm going to whatever that means to me, and within the bounds of the law. And when somebody else is optimizing, they're optimizing saying, I'm going to keep the same taste, and I'm going to remove some of these ingredients, even though I might not know the long-term impacts of these ingredients, or maybe I know the long-term impact of these ingredients has negative health consequences. So I'm over here specializing in one way with one value set, and somebody else is specializing with a completely different value set. What that event told me or taught me is to say, I got to be a little bit less trusting, I think, until the world proves to me like, yeah, Victor, maybe, I don't know, I don't want to go into it too much, but I can make my, you know what, I've got coconut oil. We'll make our own chapstick, We'll make our own insect repellent from now. We got that. And maybe having less and doing less, but having fuller control over those things minimizes a lot more risk. It's less specialized, less focused. My life becomes less focused on one thing, more things, and you have less and you do less, but you have sort of more Renaissance-like, right? More skills. And so it taught. It's not that I'm more of an expert than other people. It just means that I'm not going to completely give up and trust that other people are doing things the way I would have done it through the same value set. And that's what's changed. So I think we do a lot more. We do a lot of things on our own that we wouldn't have done on our own otherwise. We do a lot more research about very simple things that we probably wouldn't have done otherwise. And we get more sources for that research. And we do less than we do. We certainly consume much less than we have in the past. So I think that's how that period has impacted me. It's not that I trust them less. I just understand, you're talking through your incentive structure, and there might have been a period where I forgot to interpret your words through your own incentives, and then figure out whether or not the information you're giving me, how that plays with my own incentive structure. That's kind of the way I would say it, Vince. I don't know that if you should take my economic opinion over Larry Fink's, meaning it's just as good as another expert, but I do know I would like to form my own economic opinion and then hear what other people have to say as well, versus have no opinion and just have an expert give me their thoughts about what I should be thinking or doing. Rezo says, let me see. VW says, don't apologize. It's a good tangent. The Treasury market has better foresight for the economy than just about any other market. Amen. VW, amen. Rezo says, I agree with you, Vic, but we could go up for another 2 years before everything comes to roost. I agree, Rezo. If you're saying the equity market could go up for another 2 years before everything comes to roost, I think that's true. It just depends on the speed. I think if rates get there really fast, we got a problem. If rates go straight there, if rates go straight there and we go fast, we got a problem. But if we take our time, we get some back and forth action, which I think is in the market's best interest. Then I think volatility remains a bit more muted, and that's the whole point, Rezo. That to me, it's surprising that that rates are just going straight there. To me, the speed, the gamma with which rates are changing, to me, that becomes concerning, that there isn't more two-way action. Here's another one of the experts got wrong. China's economy is dead. Give me a break. We tell ourselves whatever we want to sleep better. Spring coil. Vince, here's the other thing I would say. This goes with different sources. When I was in Chicago, we have in-laws here in Singapore, and they run a steel company, and they do a lot of business in China. And so sometimes the narrative I hear from media sources, I'll ask them, or I'll send them an article, or they'll either look at it or send it to some of their friends and contacts, and they'll come back to me and they'll say, what do you think this is? Is this true? And given their on-the-ground first-hand experience, or their partner's on-the-ground first-hand experience, they'll be like, this is bullshit. This is propaganda. Like, this is not what's happening. Do I think they have problems? Yes. But I think we all have problems. You know what I mean? Do we not have problems with our own commercial real estate? Now they've got bigger problems, granted, in the real estate market, but like, we've all got our own individual issues. I'm not saying China doesn't have big problems. I'm just saying that sometimes getting firsthand knowledge or experience in some particular issue is kind of better than taking everybody else's word for it. Brian Watson, people with their fancy cars keeping up with the Joneses. That took me a long time to stop trying to do that. All right, I'm going to do a couple more of these, and then we'll get on to prices. But you guys are going like deep introspective with this stuff, so why not? I think I've said this before on this podcast, but there became a moment where I felt like such a foolish kid with what I chose to like exchange, money, sort of this like an exchange of sort of, in a way, wages for some, but it's how we choose to exchange time, in a way. Time for pleasure, time for resource, time for convenience. And I remember being a kid, and I never checked the tags on anything. Meaning I cared more about the name that was on a thing, on a pair of underwear, on a pair of jeans, on a pair of shorts, on a t-shirt. I cared more about the little letters that were printed on that thing or sewn in that thing and what the thing was made out of. So you could have gave me, you could have two things. One has no name on it, but it's made of 100% pure organic cotton, something like this, or linen, or whatever, some natural fiber, high quality natural fiber. And then right next to it, you could have a low quality synthetic fiber, but you had a fancy name printed on it. And you could charge me so much more for the low quality fiber with the fancy name on it. And it's so, it's so crazy to me that at some point in time that was programmed into me, that I never checked the tag. I didn't care what the thing was made out of, which is the most important thing when it comes to clothing. When you really think about it, it's like, what is this? Oh, this is a synthetic fiber. It's rayon, so it's basically like wood that's been processed down, with chemicals, and you're going to put it on your body. Or what is this? It's polyester, so it's sort of this synthetic fiber with oil and plastic you're going to put on your body. Or what is this? Oh, it's a natural fiber. Isn't that the thing you care about most? But no, somehow we care about the brand that gets stamped on it. I think so many kids, they grow up and their parents teach them what's important, and then in other cases, maybe your family doesn't have that knowledge. And I grew up caring about these stupid things, and how much money I gave away to people that just stamped a stupid name on it. Anyways, I hope that's one of the things that I'll get to pass on to my kids, that they won't grow up with that. But that keeping up with the fancy cars thing, it's like, how much money you guys paying? How much money you guys paying for these cars? $200,000? What? I mean, these aren't even luxury vehicles, by the way, which I can maybe make a case for, but like, people are just paying $150,000, $200,000 for a truck. I mean, if you got it, do whatever you want to do with it, but it's just crazy. People are financing this stuff. Like, and they can't afford it. It's insane to me. Let's see here. Live breaking news. What live breaking news? I mean, I wouldn't call that. It's not really that crazy, my guy. Grumpy Mike. School clothes shopping for me was a trip to the fabric store. Mom made my shirts. That's what I'm talking about. You know, I'm trying to do that right now. So that's my wife and my new thing. We're trying to make our kids, not like us, but source the fabrics and then have somebody help us put it together. I think it's probably going to lead to a divorce. She's always said that, like, I'll never work with you. Is that a good thing? Is that a good thing for your wife to say? What does that say about our relationship? That's too funny. 2006 Honda Civic and a 1997 Toyota Tacoma here. That's what I'm talking about, Ben. I didn't realize that. You know, it was the first time I had a business venture at one point in time, and one of the investors in it, they were billionaires, and I saw them driving one time in downtown Chicago. This is the last story. I'll get off onto something else. I saw them driving in downtown Chicago. I pulled up right behind, or it's like we're in the different lanes. We pulled up to a stoplight. Chicago's small, and I could see who it was. I was like, oh, that's such and such. And I looked at their car. I looked at my car. My car wasn't really that expensive, but it was a nice car. And I was like, I think my car is worth more than the car that they're driving. And right away, I felt like a sucker. You know what I mean? It was like, oh no, I made a bad decision. Because you don't get to their level unless you really understand how to measure price versus value. And they found a really good value. And perhaps I had I feel like I got a great deal in my car. But I think there's some part of it, there was a brand affiliation there too. And that I probably paid a premium for that they didn't. And at those levels, they recognize that the brand is it's some family name. And people are paying up to be associated with somebody else's family's name. Which, if you yourself have a billionaire family name, you know how silly that is. So you don't go out there and try to associate yourself with some other billionaire family who you, in many ways, compete against. So you sort of release yourself of this idea of associating yourself with other family names because you yourself are trying to build your own. And I was like, instantly, you're feeling good. It's a sunny day in Chicago, and somebody just poked the balloon. I wanted to trade that car in the same day. All right, let's keep cruising. I'm telling you. Oh, okay. I just can't stop it. I'm hoping that these are kind of all the things I want to tell my son and my daughter. Maybe there's some young kid out there, you know what I mean? Like a 22, 23, 25-year-old kid, 18, and I want to reach through the screen. I want to save you. Don't do the things I did as a young kid. And one of the things I just started doing, I mentioned this to Tom this morning, is I just went and bought 5 black shirts. 5 100% pure cotton shirts. And then maybe, I think, 5 black linen shirts, and then some, I think linen pants or something like that, shorts. I wear the same thing every day. It's the best decision I've ever made. no running to the store trying to figure out this brand, that brand, putting together stuff. Just buy the same stuff. And it's not even a new thing, it's like what all the tech titans did like 10 years ago. But one, you'll only care about the material. Two, it makes every single day so much easier, faster, and more efficient. And then when all your stuff gets beaten up, you just throw them away or you donate them and you go get 5 more of the new things. Best thing I've ever done. I like cashmere as well. Well, the thing is, Alone, I'm in Singapore, man. So I gotta choose the fabrics based on how cool, breathable, and what they do with moisture. Anyway, sorry, I don't know how this came let's talk about fabrics for half an hour. But the point is value versus price. That's really the underlying premise here, is value versus price, and how brand does or does not impact the actual underlying value. That's my point. Anyways, let's keep cruising. That was a long detour. Bitcoin up 1% in your heart, or up 1% on your screen, but down 6,000 in your heart, off that high of 109, right around 109,000. There's a part of me that wants to fade Bitcoin here. There is a part of me that wants to fade Bitcoin, meaning bet against it for the short term. I don't have the stones for that, though. I don't have the stones for that. Let me see what these guys are looking like. I would do it in a limited risk capacity. These aren't that bad. Yeah, they are on a percentage basis. I don't really know. Maybe the administration has a few more tricks up their sleeves for crypto that could be potential upside catalysts. I think they've done a lot so far. Maybe if they really want to do the Bitcoin treasury, the holding Bitcoin in treasury, but I'm not sure. I'm not certain that's going to come now. I think you probably do the regulatory stuff now, and then you probably wait until midterms to start talking about the actual treasury or holding Bitcoin in treasury. So I don't think that comes anytime soon. I could be wrong, but I don't think it comes anytime soon. And if it doesn't, what's the next upside catalyst that comes from the government? Other than regulation. I don't know. So maybe there's one or two additional catalysts that can come out of the Trump administration in the short term. But other than that, I don't know. Part of me wants to fade this thing. Just risk reward. I had always said, I thought we were going to get to 115 or 120 before rolling over. So the thing, I think it rolled. It got under 100,000 a lot quicker than I thought it would, but it recovered relatively quick. So I still think 115, 120 is in the cards, and then who knows? Maybe we'll get some stones and fade it a little bit. Watch Sailor will come out. Didn't he just buy another 11,000 Bitcoin the other day? I lose track of how much Bitcoin this guy's buying on a regular basis. Let's go crude oil for a second. 74.28. We've rolled from 79 each day. Donald Trump comes out. It seems like he is talking this thing lower with additional, energy supply rhetoric coming out of the United States. Made a reference to Saudi Arabia or the Saudis. Energy did okay today, up 0.02%. A bit of a laggard. It's been a laggard for the last week, but if you know me, I just can't help but buy the dogs. So they're going to make energy cheap. I'm going to scoop some up. Not surprising after this massive run, we've had a little bit of a pullback. To me, I just think if we can get back to 88 and sort of XLE or a lot of these energy names, I'd love to start scooping up some more. You give me energy cheap, I'll buy it, my friends. Let me read a couple years. ABE, all black everything. Scramble everything. It's called minimalism. Yep. I think like my younger self, if I could go back, scramble everything, I was a bit of a sneakerhead too. File that under dumb things I spent my money on. But I was a bit of a sneakerhead back in the day. And now I wear this, like these open, like these strap, like these Jesus, I call them the Air Moses. these Teva sandals every day. And I think if I could tell my younger self, like I wear open-toed sandals every day with no socks. Not slides, but like legit sandals. I could go running in them. I think my younger self would like, yeah, Osborne. That's right. Chris, one of these days I'm going to take you up on that invitation. Come out there to that farm of yours. Sounds like heaven on earth, man. You were living my dream. The problem is, my wife, that sounds like hell to her. So heaven on earth to me is hell on earth to my wife. So we compromised, and we live in a city state with 6 million people on a small island. That's a compromise. The sector watch. What are you guys asking about? My sector watch list? Yeah, I made it. I don't think there is one. I just made it myself. So there's 11. I use the spiders. Technically, there's a bunch of different fund families you could use. So this isn't the end all be all, but to me, the spiders, the SPDRS, that family of funds generally have the most liquid of the sector ETFs. I'll keep this up on the screen for anyone that wants to create their own. So I put these 11 sectors in a watch list, and that way every day I can just pull them up and see how the sectors are performing. I also do this with industries. I think I just deleted it though, because I wanted to create a better one. But not only do you have sectors, but you also have individual industries, and so I sometimes build an industry watch list so I can see what were the outperforming industries as well. It's a really easy way to track money flows on the day. You can do this with many things. You do it with country ETFs, so you can put all the country ETFs on a list and then just see, okay, what was hot today or the last week or whatever the case may be. You can do that with like market cap. So like, what am I trying to say? Style factor preferences. That's what I'm looking for. So like large cap, mid cap, small cap, growth, value, all of those you can put in a watch list, and then you can sort them to see what style factor preferences did the market have on an individual day. So all of those things I think are great shorthand watch lists to basically be able to look at the end of a day and just go, where did money flow? And maybe sometimes you tell yourself some story, make up some narrative fallacy as to why it happened. VW like that marital compromise. This move in gold's been a little bit brutal because I I kind of hoped I have two ways of thinking here. If gold I would love to buy more gold. That's the bottom line. But I think it's a little bit too expensive. It's too rich for my blood at $26.50, even though it seems like the Chinese like that price. But instead, I bought the miners because gold wasn't getting cheap enough. And so, the miners have moved like $4 off the lows. That's 10% in a month, people. So that chart might not look like it's done much, but on a percentage basis, I think the miners are one of the most outperforming industries for the month of January so far. So all you people have been hating on this miner call. Excuse me, sorry about that. The miners put in some work this month, finally. Dear God. I was hoping for that in December. It made me wait. All right, I can hear my two little ones outside, and I'm getting this halo effect over my head that I need to fix. So I will. We're going to call it a little bit early today. I used to have a site that had a map of all the ETF movement along with sectors, but it went under. I used this one. I'll show you guys real quick. I don't know why I'm doing this. I don't get in trouble. There's this little program out there. You can't trade on it. I use it alongside a Tasty. It's a nice. So here's what I would do. I would just build watch lists like this. Equity markets, your sectors, a couple of global markets. This is how I view the world. So I just kind of build watch lists that look like this. So that said, everybody, do me a favor, hit the like button as you get out. This is Synthetic Friday for the Price of Truth, which means I'm not going to see you until Sunday. If you didn't know, there's a show every Sunday called First Call. So when Futures open on Sunday, you can tune in to this YouTube channel, and we run a Sunday night show. We'll talk about the week that was, the events that are coming up, as well as Futures Open and how to think about them, whether there's any early opportunity. So join us this Sunday for First Call. It starts at 4:55 p.m. Central Time. Otherwise, I'll see you back here on Monday. Same time, same place, same great network, only on Tasty Live. Till then, peace.